Panel is on indirect taxes. He will be taking you through he will combine the entire, he's the head of the panel, indirect tax panel. Natarajan will summarize it all for you. That will be followed by a question answer session in indirect taxes. Then after being so indirect, we will get to be direct with Raghavan and Vardhini conducting the direct session, the changes that have come in the union budget. So if you think you've already studied the budget and you know all the nuances, you will find that you really haven't. You have probably missed the fine print. Our panel of experts will take you through the fine print, the changes that have come in, which we will be, dealing with in our practice now. And I would request Mr. A.P. Srinivas, the Tony of the Madras Tax Bar, to say a few words before we get started on this session. Mr. Srinivas, please give in your special comments before we get started. Thank you. Mr. Srinivas, A.P. Srinivas, are you there? Hari Radhakrishnan? Hari?
Yes, yes.
Yes, I think Hari, can you please start with the custom session? I think Mr. A.P. Srinivas is currently not able to hear me, or he will come
Sure,
in
sure.
between. So you please start with the customs, and
That's
then
right.
we'll.
Okay.
Thank
Right.
you. Thank you so much.
So good morning, everybody. I hope I'm audible and visible to all.
Yes.
Now, the budget has interestingly thrown some major changes as far as the Indian Customs Act is concerned. Generally, customs gets this stepmotherly treatment generally because there are not major changes in the Customs Act, and income tax and GST hogs the limelight in most of the occasions. But this time, if not the main role, at least a major side role customs has played in the this year's budget. So my attempt will be to introduce you and take you through some of the changes. And also we'll have a question answer session at the end of the session. I'll be happy to answer most of your queries. Now, before we go into the budget changes, some snippet or some tidbits how the word customs and how the word budget originated. Some of our juniors here would be interested to learn this. See, the term customs, how the term customs originated is that, customs is one of the oldest form of taxation. So whenever a trader from abroad used to come into the country, he'll be permitted to sell his goods in the territory of India, or for that matter, any country, if he pleases the king. So he has to please the king, he has to get the king's permission, he has to get the king's consent, and then only he'll be permitted to sell his merchandise within the territory of the country. So that became a custom. Every time a trader came into India, maybe from the west or from the east or from China, the trader comes and then he gives the king a costly gift. So the king gets pleased, king gets happy, and then he permits the trader to sell his goods into India. So that gifting the king became a custom. Every time a trader came, you have to give a gift, king is happy, and you are permitted. So that custom, and all the kings became accustomed to that. And today it's called as a customs duty. That's how the terminology came of the customs duty. The custom of giving a gift in the form of a kind or a goods to the king. Now we give what is called as a customs duty. Now kings only accept in cash. There is no kind. So that's how the term customs duty originated. And now we have the Customs Act 1962, the Customs Tariff Act 1975, and these are the statutory mechanisms to enforce the customs law. Now, if you see the budget is comes from a French word, bogue. I don't know whether I'm pronouncing it correctly. It's bogue, which means a small bag. And bogue in turn means a small leather briefcase. So it said that the then finance minister of England in 1733, he had brought the budget papers in a small bag. And that's how the term from French has been adopted to the English language. And as far as India is concerned, in the after the revolution in 1857, the first revolution, the budget was presented then by the East India Company, and then after independence on 26th November 1947, the first budget was presented in India. So that's the origin of the term customs and budget. So just a small snippet, I thought maybe of some interest to the juniors moving forward. So as far as the changes in the Customs Act are concerned, the first important change is that there has been some kind of a finality to the endless provisional assessment. Now, provisional assessment under customs came under Section 18 of the Customs Act. Those who are practicing customs would be aware that these provisionally assessed bills of entry or shipping bills, as the case may be, were kept endlessly in the queue, were not being finalized, and the importers and the exporters were not given back their security in the form of bank guarantee or cash deposit, which they had given. There was no mechanism, there was no provision for finalization of provisional assessment. A lot of regulations were brought in earlier. In 2011, there was a regulation, and then they removed that regulation, substituted with a circular, which also did not provide for a timeline. Then they brought in a new regulations in 2018, Customs Provisional Assessment Regulations 2018, which provided for the first time a statutory time limit, so to say, for finalizing the provisional assessments. So what is a provisional assessment? Provisional assessment is that if the importer or the exporter is unable to self-assess the bill of entry or the shipping bill, as the case may be, for any reason, maybe he is not having a test report or he is not having some document, and therefore is unable to self-assess the duty payable, then he can opt for provisional assessment, or the assessing officer or the proper officer of customs can provisionally assess the goods under Section 18 of the Customs Act. So after provisionally assessing, what happens is the proper officer takes some kind of a security. He takes maybe a bank guarantee or a fixed deposit or some kind of a security he will take, and then he will provisionally assess the bill of entry and he will permit clearance of the goods. Now, these provisional assessment files were lying dust in the custom house, most of the custom houses. And unless you have some extra considerations, these files are never pulled out from the custom house and taken up for finalization. Boards initially issued a circular under the Central Excise Act saying that because the provisions are similar, Central Excise Customs provisions are similar, therefore the board used to issue circulars under the Central Excise Act, which were applicable to customs also because the principles are same, where they said you should finalize the assessment within 6 months. Then you should also, if you're not able to complete the assessment within 6 months, you get permission from the commissioner. And maximum within 1 year, please finalize the assessment. These circulars obviously were never implemented, never at all implemented. And the provisional assessment regulations 2018 brought in a time limit where they said within a period of 3 months, please finalize. Otherwise, you get extension from the commissioner. Now, these regulations are enforced from 2018. But even in my experience, I don't know the experience of my learned seniors and others, these regulations were also not implemented to the T. A lot of loopholes, and never these timelines were adhered to. In fact, I have filed, there are repetitions pending which say that these timelines in the regulation should be considered to be mandatory and they're pending disposal. But now, very interestingly, they have brought in a provision where mandatorily the provisional assessments have to be finalized within a period of 2 years. And if within 2 years, these provisional assessments could not be finalized for any reason, then the Commissioner of Customs can extend for a period of 1 year. Obviously, there are some exceptions to this rule. For example, if there is a stay granted by the High Court, or if the board has issued a circular to keep this pending, or if the document required for finalizing the assessment is called for from abroad. For example, in the country of origin rules, whenever goods are imported under the free trade agreement, as you're aware, you have to submit a country of origin certificate. Of late, there are a lot of cases being booked that these country of origin certificates are forged, fabricated, or that they don't contain the QR code. And therefore, there are many cases where the country of origin certificates are not accepted, goods are being provisionally assessed and being cleared. So in these cases where verification is going on with the country of export regarding the genuineness or authenticity of these country of origin certificates or other documents, in such cases where the verification is not complete, Section 18(1)(c) says these time limits will remain suspended. Similarly, if there's a stay from the High Court or there is a board circular or any such reasons, but the law also stipulates that if the proper officer is not able to finalize a provisional assessment within the period of 2 years plus 1 year, as the case may be, then they have to put the importer on notice, and only after issuing a notice can they suspend under Section 18(1)(c). Therefore, this is the great amendment to the Customs Act by bringing a finality. One major change is that SVB investigations will now be expedited. SVB, for the juniors who are not maybe aware of the terminology, is a special valuation branch which is opened in the Custom House, which scrutinizes the imports made between related parties. So the law presumes that if there is an import between related parties, then the value declared at the time of assessment may not be genuine or may not be at arm's length. Therefore, the custom house has built in a cell called as a special valuation branch, which scrutinizes the imports made between related parties and will study whether these prices are genuine at arm's length as per the customs valuation rules. So generally, these SVB cases, what happens is till the investigation is completed, all assessments are kept provisional, and I have to pay what is called as an extra duty deposit. Now the circular says that extra duty deposit need not be paid if the fault is with the officer. But again, I said circulars are not properly implemented, but still the circulars requires payment of EDD. The customs officer requires the payments of EDD, extra duty deposit, which is over and above what you pay the customs duty. So now, by bringing a time limit for finalization, these SVB cases will get expedited, and the foreign companies who have got their subsidiary branches in India, they will be most happy because now there's a certainty in the prices declared by them. So that is there. And then, as I said earlier, the customs finalization of provisional assessment regulations has been given some teeth because now those regulations have now been, so to say, statutorily codified and given the force of law to be implemented properly. And the importers, exporters are very happy because bank guarantees will now be returned if the assessments are accepted. And this also is a big decision which has been taken by the Parliament to bring in this law, Section 18(1)(a).
The slide should be SVB investigations will be expedited, right?
Yeah, will be. I'm sorry. I stand corrected. I said not. Should be, will be expedited. I stand corrected. Now, the next important provision under the Customs Act is the voluntary revision under Section 18(A). This is again a game changer, a superb provision which has been brought in. Because earlier, if there was any correction or error in the assessment, then the only recourse is twofold, as per the decision of the Honorable Supreme Court in ITC Limited, where the Honorable Supreme Court said that if there is an error in calculation of duty or payment of duty, then the only recourse is you must file an appeal against the order of assessment made in the bill of entry or shipping bill. You cannot straight away rush to the refund section and file a refund claim. This is what Supreme Court said in ITC. The officers also interpreted that only if an importer files an appeal against the bill of entry, gets the bill of entry reassessed by getting an appellate order, then only he can file a refund claim. But the officers overlooked the fact that there is another provision, Section 149 of the Customs Act, which permitted an importer or exporter to seek for amendment of the bill of entry based on documents which are existing at the time of import. For example, suppose an importer has imported some goods and there is an exemption notification which he has lost sight of at the time of filing the bill of entry. It may be the importer's error or the CHA's error. Now, the Section 149 says you can seek an amendment of the bill of entry because the notification which gives exemption was existing at the time of import. Therefore, under 149, you could have amended the bill of entry and then claimed the refund of the excess duty paid. Now, Section 149 provision, though it's there in the statute book, the officers are very reluctant to enforce this provision because they say that no, 149 will not apply if the goods have cleared and crossed the customs area. So based on this erroneous interpretation, lot of claims and applications for amendment of the bill of entry used to get rejected. So ultimately, we had to come to the High Court, get an order, and then ask for reassessment of the bill of entry. Or the other route is, which I said earlier, as per ITC Limited or the Supreme Court, you have to file an appeal against the order of assessment. Now, generally, appeal period is 60 plus 30. So generally, many importers may miss the timeline because by the time they come to know about the fact that they have wrongly assessed the duty, the time limit would have already expired. So 149 is resorted to. And 149 is never allowed by the officer. Now, 18A clears the issue. 18A clearly says that an importer-exporter can revise an entry after clearance of the goods. So even though 149 permitted amendment of bill of entry after clearance of the goods, officers did not accept to it. Now the government said, okay, now let us change the law. We'll bring in 18A. 18A says that even after clearance of the goods, you can revise an entry in the bill of entry. So once you revise an entry in the bill of entry, of course, the conditions are yet to be prescribed. So I presume there will be a regulation which will soon follow. So that says that even after clearance, the bill of entry or shipping bill can be amended, and the amendment will take the force of a self-assessment. So just as how you file a bill of entry or a shipping bill, and that is considered to be a self-assessment, the revision that you make under Section 18A will also be considered to be self-assessment. And accordingly, if any differential duty is payable based on your own revision, you have to pay the duty with interest. Or if your refund arises as a result of such revision, then you can claim a refund. So this provision is a beautiful addition to the Customs Act, much needed one, and a great relief for various importers and exporters who sometimes miss the bus in claiming a particular notification or making a wrong classification. Or there may be even cases where they wrongly mention the currency. The import invoice may say Singapore dollars, but the CHA may put it as US dollars, and as a result, enhanced or excess duty is paid. So all these errors can now be corrected under Section 18A. Of course, this is not without exception. Cases where the audit or seizure or summons cases where there is an offense is made out, you cannot revise. And similarly, where the proper officer himself has revised the duty under Section 17 of the Customs Act, you cannot again ask for revision after the proper officer has revised under Section 17. So therefore, Section 18A can only be applied where the proper officer does not reassess the goods under Section 17.4 or 17.5, and cases where there is no investigation, search, or seizure cases. So in other cases where there is a error, bona fide error on the part of the importer exporter, Section 18A can be pressed into service. And this is one of the biggest amendments which has come in the recent times under the Customs Act, because a lot of issues are regarding amendment of the bill of entry. Now, there are consequential amendments which are made to Section 27, because as you know, the provision for claiming refund of customs duty is Section 27 of the Customs Act. And the Section 27 states that the time limit to file a refund claim is 1 year. So since now, as a nature of this revision of entry, the reassessment, so to say, takes place at the end of the importer-exporter, consequential amendments have been made under Section 27, saying that time limit will come after 1 year from the payment of duty, if any, under Section under 18A, or refund, as the case may be, under Section 18A. Similarly, under 149, this is also an amendment which is very important, because generally what happens is, if an amendment is made under Section 149, there is no express provision to say that the time limit to claim refund will arise within 1 year from the date of the reassessment or amendment of the bill of entry. But this was a natural, logical corollary. But they have now statutorily brought it, saying that the time limit will begin to run from the revised entries under Section 18A or Section 149, as the case may be. Consequently, amendment is also made to Section 28, demand. So refund timelines are enhanced to claim refund. Similarly, under the timelines to make a demand of customs duty under Section 28 are also enhanced naturally. Because if there's a revision of any duty under Section 18A, and if the importer does not pay it voluntarily, then Section 28 can be pressed into service. And similarly, the time limits to demand duty will also get increased, or will be reckoned from the date of the revision under Section 18A. So these are all consequential amendments made under 18A after an importer or exporter chooses to voluntarily revise the entry made under the bill of entry or the shipping bill, as the case may be. Now, another important change. So 3 important changes in the Customs Act. It's 3 consecutive hat trick, so to say, or 3 consecutive sixes is that. First is, as I told you, provisional assessment timelines have been introduced. 2, a voluntary revision of entry under Section 18A. And 3, Settlement Commission now has been given a decent burial, so to say, because with effect from 1/4/2025, the power of the Settlement Commission will now be exercised by the interim board. Now, I understand that under income tax also, subject to correction from those who are practicing income tax, also 2021, an interim board was introduced to replace the Settlement Commission. So I think the same concept now has come under the Customs Act. The Settlement Commission under the Customs Act, Central Excise Act, has now been replaced by the interim board. Now, the interim board, the law says that after 1/4/2025, no further applications can be filed for settlement under Section 127 capital B of the Customs Act. So it is only applications, the last date is 1/4/2025, and that too, all the applications will now be heard by what is called as an interim board. So who will constitute the interim board, and other those consequential changes and amendments have also been introduced. And as I said, all the pending applications will be dealt with by the interim board for constituted under the Section 31A of the Central Excise Act. Now, what is the reason for changing this settlement commission? Why to give it a burial? Why no applications after 1/4/2025? Maybe the government feels that settlement commission has outlived its utility. And since a lot of voluntary compliance is being encouraged. Now, if you see, generally section 28(4) has a provision where it says 28(4) is the provision which provides for extended period of limitation. 28(1) is the normal period of limitation of 2 years. So 28(4), that which is the extended period of limitation, says that if a noticee pays the entire duty, interest, and 15% of the duty amount as penalty, then no further proceedings will be initiated under Section 28A. So therefore, already there is a mechanism where importers who had willfully evaded tax would be given a reduced penalty. Benefit was already there under the Customs Act 1962. Maybe that was the reason why the government felt, or the parliament felt, that now settlement commission is not required, because you have brought in a lot of voluntary compliances and consequential amendments where giving more liberty to the trade. At the same time, you must not give a longer hand or a larger leeway to evade us. So therefore, settlement commission, maybe that is the reason why they're now discontinuing the settlement commission. And also, a lot of administrative issues settlement commission was facing. There was no members, staff was not there, very slow. In fact, settlement commission applications which were filed 2 months back, no admission orders were being passed as required under the Customs Act. And therefore, maybe because of these administrative issues and because government felt that we are trying to encourage voluntary compliance, therefore let us not give a bed of roses to evade us. Maybe that's why they felt that after 1/4/2025, no further application we will entertain. But I hope that because this is a sudden change in policy, some scheme like the Vivad Se Vishwas scheme under the Income Tax Act could be introduced, probably in the near future, to see that all past cases where show cause notices are already issued and where applications are not filed by 1/4, probably a one-time settlement could be brought in as a last chance for everybody. This way, probably more revenue also the government could generate. Maybe this is just a thought. Don't know whether government is thinking this direction. But maybe some scheme like Vivad Se Vishwas scheme could also be introduced, since settlement commission now is not being continued, or no application is being entertained. I will use the word no application is being entertained after 1/4/2025, because there's a specific amendment. A proviso is introduced to section 127(b)(5), which says no applications can be filed after 1/4/2025. Then this is as for the changes in the Customs Act, which is the substantive law, Customs Act 1962. Then there is a second law under the Customs Act, which is the Customs Tariff Act 1975. So as you know, under Section 12 of the Customs Act, customs duties are levied as per the rate specified under the Customs Tariff Act or under any other law for the time being in force. So the rate or the tariff card, so to say in hotel terms, is under the Customs Tariff Act. So what are the changes? There are some increase in the tariff rates. I don't want to go into what are those items which are increased. It will be too boring. And there are some decrease, though. Those increase will come into effect immediately to 2025. But whereas there's a decrease in the tariff rates, this comes only after the assent of the Finance Bill 2025. One important change, because this is a very hotly contested case under the customs, is the classification of a product called as the interactive flat panel display. Now, what happened is these interactive flat panel displays, which is nothing but a big screen where it has got an inbuilt CPU, and a user can interact with that screen. And as you have seen in malls and other areas, airports, etc., all those big screens are called as interactive flat panels. So the tariff currently under 8471, because this is an automatic data processing machine, it was nil. And advanced rulings were being issued, SESTAT orders were being issued, saying that it is nothing but a computer, therefore it should come under 8471 of the customs tariff. Now, government in fact has now nullified, so to say, all the advanced rulings. Interactive flat panel displays are now being taxed at the rate of 20%. So this is a major change as far as importers of these products are concerned, which are being largely imported through Chennai and Mumbai and Navasheva. So this is a major change for various importers. Then push to Make in India campaign. So as you know, Modi ji is ensuring that India is now the center for all, as far as manufacturing activity is concerned. We want to take China heads on. So what to do, how to take China heads on is by encouraging Make in India campaign. And therefore, important changes, because a lot of these TVs are coming from China. So they have said that we will give you incentives. All inputs and parts for open cell for use in manufacture of television panels are exempted. So another benefit for TV manufacturers. Then open cell for interactive flat panel display model reduced to 5%. These are all to encourage TV manufacturing in India. Then automobile sector is also being pushed. So in fact, as you know, China, this automobile sector is also the second, one of the major sectors in China. So that also we want to see that we are able to, or we are in a position to compete with them. So motor cars with the CF value of more than $40,000 or engine capacity more than 3,000 cc, reduced from 100% to 70%. So these are all more than 3,000 cc would be big vehicles, or I think vehicles, luxury vehicles only would be having such cubic capacity, or sports cars, etc. They're all reduced from 100% to 70%. Then motorcycles in complete knockdown conditions or completely built units, semi-knockdown, all reduction of duty is there based on engine capacity. At different rates, how they have been broken down and brought in, based on that, there is a reduction of duty, customs duty. Then capital goods for manufacture of lithium-ion batteries. This is a major change, because for EVs, battery is the main thing. And for manufacturing battery, all capital goods now are being exempted. And for manufacture of both lithium-ion battery and also for battery for mobile phones. Similarly, the waste and scrap are also being exempted for this purpose. Yeah, so that is as far as changes in the automobile sector. Then new tariff items are created. So in the customs tariff, based on the products that are now newly discovered or invented or made, always there's a change in the customs tariff. So these are some of the items which have been introduced in the customs tariff, like variety of rice based on process of parboiled. It's obviously not very important from an advocate's point of view, in the sense just to know that new entries have been created and some changes have been made to align with the World Customs Organization HS code. So just for juniors information, as you know that the customs tariff is aligned with the harmonized system of nomenclature, which is maintained by the World Customs Organization. So whenever there's a change made by the World Customs Organization, to which India is a member, consequential changes will be made to the Indian Customs Tariff Act. Obviously, these changes are made slightly delayed, but anyway, they are aligning it with the WCOHS, and all those changes are there in the Customs Act. These you can easily find out from the internet, so I don't think I have to explain what are those changes. But just to bring it to attention, changes have been made and some new tariff items have been created in the customs tariff. And there are some miscellaneous changes also are there. For example, most of the goods which are being imported and where duty is exempted to give fillip to the Make in India campaign, the notification specifically prescribes that you have to follow the import of goods at concessional rate of duty rules. There are separate rules which have been framed, where an importer has to submit an application for registration with his jurisdictional officer, and only after submission of registration can he import the goods at a concessional rate as per the customs notification. For example, as I told in the earlier slides, the open cells for manufacturing LCD, etc., for lithium-ion battery, etc., all these notifications exempt duty subject to the condition that the importer registers under the import of goods at concessional rate of duty rules. So the condition or exemption is conditional. And that condition, now there is some leave or some more leeway is given. Rules 6 and 7 of those rules are being amended for increasing the time limit for fulfilling the export obligation or fulfilling the conditions of the notification from the current 6 months to 1 year. And then instead of giving quarterly statement, monthly statement, they have made quarterly statement instead of the earlier monthly statement. So compliances have been eased by making changes to the import of goods at concessional rate of duty rules. And similarly, agricultural infrastructure and development cess has been imposed on 32 items. And on the other hand, social welfare cess has been exempted on 25 items in this budget. And exemptions and concessions which were earlier given have been continued for certain items. As you know, earlier exemption notification did not have a time limit. For the last 2-3 years, exemption notifications were given a time limit up to a particular year or a particular date, and some exemptions are being continued. So these are all procedural changes. So I'm not going into what goods, what is the exemption, what has been increased to what date. So these you can easily check up from the internet by looking at the notifications, but bring it to your attention that the exemptions have been continued. So these are all the changes under the Customs Act. I think I've covered all the important changes, and maybe after the GST session is over, we can have a question and answer. I'll be happy to take some questions from my friends.
Thank you so much, Hari, it
Yeah.
was an excellent, exhaustive session where you managed to give a bird's eye view of the major changes with an incisive analysis of each of the aspects. Thank you very much. We will
Thank you, ma'am. Thank you.
so question answer session for this, we can take it up together after the GST session.
Yes.
Natarajan will round up the entire session. First, Aditya Reddy, I think, has prepared some slides. Is he in? Kindly, Natarajan, kindly.
Actually, ma'am, the slides were prepared by Natarajan sir only. He was gracious enough to allow me to use them. So I will show the slides, and I will run through the basic proposals that have been brought in with respect to GST in the budget. And I will, in the course of going through the issues, I will flag some issues of discussion which Mr. Natarajan will address after I am done with referring to the topics. Issues which may lead to further controversies or further litigation, which may need some clarification. So I'll just flag them as I go through the issues. The first slide, I think the best place to start is obviously with the good news. The good news is that the budget throws out the last vestiges of the taxability of vouchers under the Act. As we all know, it has been a matter of pride for the Madras Tax Bar that it was our Vice President and our founding member, Ms. Aparna Nandakumar, who spearheaded this issue, this litigation right from the lower authorities, and got the law settled by our High Court that vouchers are just actionable claims and that there is no taxability at the time of purchase or sale of vouchers. The taxability only, the taxable supply only happens when they are redeemed at a subsequent stage. So that was the law that was laid down, and there was a circular by the government accepting it. And now the only thorn in the flesh was these two provisions which mentioned the time of supply for taxability of vouchers as the time of their actual purchase, which was not in line with the law that has been laid down. So those two provisions have been removed. The time of supply provisions for vouchers have been removed, thereby settling the law once and for all that there can be no tax on sale of vouchers. So that is the least controversial part of the budget proposals for GST. So we will start with that. And like I said, it's a matter of pride that this law was settled once and for all at the instance of one of our founding members, Ms. Aparna Nandakumar. The next issue, if I may move on. Shankar, can you just go to the next slide? Yes. The next issue relates to a condition imposed for a supplier to reduce his output tax liability whenever a credit note is issued. As we know, under Section 34, there are certain circumstances in which a credit note can be issued, thereby leading to a reduction in the output price, output value of the commodity of a supply, and consequential reduction in the tax also. Now, examples are where there is a inadvertent mentioning of wrong rate or wrong value in the invoice, or when the material is returned for quality issues, etc. So, in all those circumstances, the mechanism prescribed for reduction of the price was the credit note. Now, the obvious consequence was that the purchaser cannot take credit for the value of the reduction. That was the obvious consequence. But the mechanism that was prescribed or that was available was that once the credit note is raised, the supplier will reduce the value in the GSTR1. That will get reflected in GSTR2A, and then in 3B, the reversal gets auto-populated in 4A2, the column 4A2 of the GSTR3B form. That was how it worked. Therefore, the reduction in the output rate was first in GSTR1, and that led to reduction in the reversal of the ITC at the hands of the purchaser. But now, what has happened is the reversal of credit has been made a precondition for the reduction of the output rate. So, so this actually is in line with a provision which was already there for transitional contracts alone. Section 142B proviso said that whenever there was a contract that was entered into before the coming into effect of GST, and subsequently there is any change in price and a credit note had to be issued, the proviso to 142B specifically said that you should first, the purchaser should first reverse the credit and then only the credit note can be given effect to. Now that has been made applicable to all transactions involving credit notes. Therefore, the ITC now has to be reversed first before the output rate is reduced. Now, I request Mr. Natarajan to clarify on how this mechanism is expected to work in light of the fact that earlier the GSTR 2A was used to affect the reversal ultimately in 3B. Thereby, it's a case of reversal of the orders as it were in the manner in which the mechanism worked from before. The next issue, Shankar, if you can shift, is So this again, I would say, is a kind of a lacuna which has been filled by the legislature, which was that 107 was section 107, which provided for the first appeal to the appellate authority, provided that whenever there is a tax demand on payment of 10% of the tax as pre-deposit, there is an automatic stay on the rest of the demand. Now, there was no clarity with respect to penalty because A, there was no pre-deposit requirement for penalty. Therefore, definitely you could have filed an appeal when the demand had only penalty without making any pre-deposit. But in the absence of a provision that provided for automatic stay, like how it did for cases of tax demand, there was some lacuna, according to me, on what would happen for the rest of for the demand during the pendency of the appeal. That is, whether there is a stay of recovery or no, was a matter of lacuna, and the legislature has now filled it by mentioning that the pre-deposit condition for penalty, which was restricted to 129 penalties, that is in case of goods retention, etc., is now applicable for all kinds of penalties, including penalties under 73-74. But the rate has now been reduced from the pre-deposit amount has been reduced from 25% to 10%. So I am assuming, therefore, that the legislature intends for there to be an automatic stay even in cases where there is a demand of penalty alone on payment of 10% of the penalty. Here, the only issue that I foresee, on which I request Mr. Natarajan to clarify, is that is there something unreasonable about asking a person who is faced with both tax and penalty to pay only 10% of the tax and not pay anything for the penalty, but somebody who may have paid the tax already even before the SCN in case of a Section 74 defect, and therefore is now faced with a demand of only penalty, he is now required to pay 10% of the penalty. Whereas somebody, like I mentioned, who has not paid anything but is now faced for the first time with a demand containing both tax and penalty, is required to pay only 10% of the tax and not pay anything of the penalty to get a stay of the demand. So is there something unreasonable there in terms of discrimination or something, or am I missing out something in what the legislature has intended to do? Is something Mr. Natarajan can clarify when he is going to sum up the issues. The next issue, so this is again the vexed issue of evasion-prone commodities. Now, personally, before we go into what the legislature has done, personally, my view is that year on year, in spite of all the stringent measures that are being brought in, we keep seeing news reports of how big rackets of fake traders and brokers are being arrested and caught, and action being taken throughout the country. There is really no reduction as far as those kind of cases is concerned. So And the long-term solution to this problem of evasion-prone commodities is not going to come from any immediate measure like what has been proposed. There have to be some long-term measure on addressing probably the problems in society itself, or there has to be some kind of trust that is built between the trade and the government. That again, like I said, is long-term. Anything else will only be treating the symptoms and not providing a cure for the problem. So this measure, which has now been proposed, I think is again a measure to treat the symptom, which is to provide a track and trace mechanism for commodities from their source till the end consumption. That is, the government has contemplated something like a QR code or a unique identity marking that will be affixed on the seal on the packaging, which I think will be tamper-proof and which I think will be detectable by the department at any stage digitally, so that any tampering in the process in the supply chain can be avoided. And there is also a consequential penalty provided for failure to affix this marking while packing the goods. Now, the complication that can arise here probably, first of all, the goods that are supposedly evasion prone haven't been identified. That probably will come out by way of a notification. Also, the exact mechanism for this track and trace marking hasn't come out. So all that will also come out by way of notifications in future for sure. But in spite of all of this, some problems that could occur are what happens in cases of goods that require splitting at every stage of the supply, from one supplier to another. So when quantities have to be split, or what happens in cases where the goods require some kind of a minor processing at each stage, then how do you ensure that this marking remains protected throughout, or that the marking, this digital marking remains reliable throughout, or is are the rules going to provide for different markings at each stage, leading to more complications? These are things that we have to see, I'm hoping Mr. Natarajan will throw some more light on this. The next issue is, I think, again, a beneficial provision where it is clarified that any supply from an SEZ or a free trade warehousing zone before customs clearance is not treated as a supply, as a taxable supply for the purpose of GST. Basically, they are extending the benefit that was given to high sea sales and to goods stored in bonded warehouses before clearance to SEZs and free trade warehousing zones. So I think it is a logical extension of the benefits, because imported goods in all these cases are similarly placed and are yet to come into the domestic market, and therefore it is reasonable that they are not treated as taxable supplies. And I don't think there should be much controversy as far as this provision is concerned. Next. So this I am not going to say much about, because this is the hot topic, and this is probably, since I started with the good news, since I started with the good news where the legislature accepted the judicial pronouncement in the case of vouchers, this is probably the bad news for the market and for the industry, where the legislature has chosen not to accept the law laid down by the courts and has decided to undo it. So the question now is only this: we all know that whether a law that undoes the effect of a judgment is valid or not depends on whether it has simply removed the basis of the judgment or whether it has actually violated it. So I would request Mr. Natarajan to elaborate on this issue as to whether the budget proposal for amendment of section 17(5), whereby the terms plant or machinery in 17(5) have been retrospectively amended to mean plant and machinery, whether this amendment merely removes the basis of the safari retreat judgments, or does it actually violate the law laid down, will be the moot question on which I request Mr. Natarajan to elaborate. So these are, I think, the major amendments that have been proposed, and amendments that have potential for controversy or amendments that set to rest controversy that have already arisen. Apart from this, there are 2 or 3 other proposals which, according to me, are not very impactful. For example, in the case of input service distributors, it has now been clarified that the provision first, of course, is now in the registration for an input service distributor has become mandatory, and the mechanism for input service distribution is applicable not only for regular input tax credit, that is for purchases, but also it has been made applicable for tax
Next
paid
slide,
under the RCM mechanism for interstate supplies. So that is an increase in the scope of interstate service distributors passing on of credit, for nature of credit that is passed on. That is one amendment that is, according to me, relatively uncontroversial. That's going to be relatively uncontroversial. The other one is the explanation of the terms local fund and municipal fund, which are part of the definition of local authority and municipal authority under the relevant notifications.
slides.
No, ma'am, they're not part of the slides, ma'am, because like I said, they are not, they're relatively uncontroversial amendments. So I'm just mentioning them on the passing. So the issue of what is a local authority and what is a municipal authority becomes relevant because under the notification there are some exemptions and there are some rate of tax implications depending upon whether you are a supplier for a local authority or a municipal authority. So only to clarify the definition of those terms, the terms local fund and municipal fund have been explained. The explanations have been provided, which was not there hitherto. So except for these 2 or 3 additions, which, like I'm repeating, are not going to be controversial. The issues that are going to be controversial are part of the slides, and I invite Mr. Natarajan to address the issues that I flagged and also add anything else that he feels is relevant. And I hope all of us will benefit from his experience inputs. Thanks.
Yeah, thank you, Aditya. Let the slides remain. So I may have to refer to them once again. Let it remain on the screen. Now, Hari has explained the origin of the word custom and how we people have become accustomed to the levy of customs duty, so that the amendments on customs are very much non-controversial. We have seen a lot of amendments in the customs on rationalization. See, nowadays, the very difficult question to any practitioner in customs is, if somebody is going to ask what is the customs duty for a particular product, we need at least half an hour to give an answer. We have to refer to the tariff, notification, amendments to the notification, everything. An attempt has been made in this budget to align all the rates to the tariff. Instead of looking at so many places, we will maybe at a distant point of time, maybe in another next 2 or 3 years, we will be able to identify the rate of customs duty at a mere look at the tariff instead of going through a labyrinth of notifications. An attempt has been made, which is really very good. So we are slowly becoming accustomed to customs, as Hari put it. But unfortunately, with the GST, we are yet to become accustomed. It is just hardly 7 years old. And that is why still we feel the custom in GST. So still GST proves to be a difficult matter for all of us to understand, with a lot of difficulties and all that. 1 or 2 issues which were highlighted by Mr. Aditya Reddy was coming to that penalty pre-deposit provisions. Can you please go back to that slide? The penalty pre-deposit, there is a taxpayer, and whoever is operating the screen, you can go back to that pre-deposit scheme, pre-deposit one. See, suppose in fake invoice cases and all, there may be a case where
Well, it's the screen with section 107. Shankar, can you just go to the screen with section 107?
Go back to that screen, yeah. So, whenever there is only a penalty on a particular person, when he files first appeal, he is not required to pay any pre-deposit. In second appeal tribunal also, he is not required to pay any pre-deposit. That was the original position. If there is a tax demand along with the penalties on a person, that person has to deposit. The admitted tax liability should be paid in full, and 10% of the disputed tax liability should be paid as a pre-deposit when we go on appeal, the first appellate authority. When we go on second appellate authority, another 20% of the disputed tax, which was reduced last year to 10%. So totally there is a deposit of 10 plus 10, 20% as far as the disputed tax demands are concerned. If penalties are imposed on the same person, he need not deposit anything towards penalty. If there is a person on whom only a penalty has been levied, no tax demand, then there was no requirement of pre-deposit. And few years back, they brought an amendment on all these road detention matters where 200% penalties are imposed. 25% of the penalty should be deposited while filing the first appeal. That was the requirement which was brought in few years before. Other than that, any other penalties under section 122, 73, 74, there is no requirement of pre-deposit. Now, they have brought in a provision whereby wherever there is only penalty imposed on a person, when he files first appeal, he has to pay 10%. When he files the second appeal, he has to pay another 10% of the penalty as the pre-deposit. So, as a corollary, since this has been done by way of substituting the existing provision pertaining to section 129, even for detention matters, the 25% penalty will now come down to 10%. And in other penalty cases, where there was no requirement of pre-deposit, they will be asked to pay 10%. That is the effect of all these amendment. So now coming to the point raised by Aditya Reddy, is it discriminatory or something? So what I feel, subject to the views of others, the right of appeal is a statutory right granted to any person. Any person who is aggrieved by an order, he has been given a statutory right of filing an appeal. But that statutory appeal is subject to various conditions. One of the conditions is the requirement of pre-deposit. So a person who has been served with an order with tax as well as penalty, the quantum of deposit has been fixed as 10% of the tax amount and nothing on the penalty amount. Whereas in case of a person who has been levied only with a penalty, the requirement is 10% of that penalty. So I don't think there may be any serious issue of any discrimination in this provision because it is a condition attached to a statutory right. Subject to what others have the feeling on this, maybe we'll hear in the end. Coming to that credit note provision, kindly go back to that slide dealing with the credit note. Yes. See, when a supplier raises an invoice and pays the tax is paid and the recipient is taking the credit. Now, for various reasons, a credit note can be issued. Suppose the material is returned, it is coming back. The supplier will issue a credit note. He will upload the credit note in the GSTR 1 return. It will reflect in the 2A, 2B of the recipient. So now, the supplier has originally paid tax on the supply. The material has come back. So he has to get back the tax originally paid by him. But the buyer would have already taken the credit. So the requirement was the buyer should reverse the credit. And once the buyer reverses the credit, the supplier will get back the tax paid by him. How he will get back? Not by way of refund. In subsequent month or whenever the credit note is raised, whatever tax that person is liable to pay, from that he can reduce the tax impact on the credit note. This was the mechanism. So the requirement of reversal of credit was not specifically stated. Now they are bringing it into section 34 itself and making it as a precondition. Whenever the supplier claims reduction of the output tax liability, the buyer should have reversed the ITC. Here we will be faced with some issues like whenever the recipient is not reversing the credit, supplier has issued the credit note and that credit note is figuring in our 2A, 2B, whether the recipient is mandated to reverse the credit. If you see the provisions, there is no mandate for the recipient to reverse the credit. The law does not say the recipient has to reverse the credit. It only says if the supplier wants to reduce his output tax liability, the buyer should reverse the credit. So if the buyer has not reversed the credit, the department cannot go to the buyer and compel a reversal of the credit. They should only go to the supplier and check whether he has reduced the output tax liability. If he has reduced his output tax liability, but the buyer has not reversed the credit, the department should proceed against the supplier. His reduction of output tax liability is not proper. This is further fortified by the fact there are cases where commercial credit notes are issued, not GST credit note, mere commercial credit notes, only for value. If it is issued, there is no requirement for reversal of credit by the recipient. So the way the provision was worded earlier And even after this amendment, the legal position seems to be there is no mandate, there is no compulsion on the recipient to reverse the credit. If the supplier wants reduction of his output tax liability, in other words, if the supplier wants to claim refund of the tax originally paid in excess, then it will be possible only if the recipient reverses the credit. So this seems to be the legal position even after this particular amendment. Another very important amendment, the much talked about amendment, both pros and cons, even in our groups also, we have been seeing a lot of conversations being going on, is about the safari retreat. Can you kindly go to that particular slide? Yes. See, these two clauses were the subject matter before the Supreme Court, 17.5C and 17.5D. 17.5C reads as work contract services when supplied for construction of an immovable property other than plant and machinery, except where it is an input service for further supply of work contract service. Pausing here, work contract is a combination of goods and service. So, whether to treat a work contract as a supply of goods or as a supply of service, for that the answer lies in Schedule 2. Schedule 2 says work contract will be treated as supply of service. So, Class C deals with work contract service. Suppose if I am receiving a work contract service from somebody, that is, I have given a contract to a contractor with material to construct my factory building, whether I will be able to take ITC of the GST charged by the contractor. That is the question. So the law says the Class C is a negative provision. It's a blocked credit. This credit is not eligible. Which credit is not eligible? Work contract services when supplied for construction of an immovable property. But if that immovable property is in the nature of a plant and machinery, suppose I am constructing a factory building in which there is a big boiler which is attached to the earth and permanent. It cannot be removed from the earth. So even though it is in the nature of an immovable property, a boiler is a plant and machinery. So any GST paid by the contractor in erection, commissioning, installation of the boiler is not blocked. I am eligible to take the credit. That is one exception. If the immovable property is in the nature of plant and machinery, credit will be eligible. The next exception to the exception is where it is an input service for further supply of work contract service. I am a construction contractor. I provide work contract service to my customer. In turn, I have subcontracted a portion of the work or the entire work to another subcontractor. So that subcontractor is providing work contract service to me. In turn, I am providing work contract service to my customer. Then I am eligible to take the credit. So except these two situations, input tax credit will not be eligible in respect of work contract services. So this is the import of Class C of Section 17.5. Now come to Class D. Goods or services or both received by a taxable person for construction of immovable property other than plant or machinery. Here they have used the word plant or machinery on its own account, including when such goods or services or both are used in the course or furtherance of business. See, Section 16 says anything which is used for business or in furtherance of business, credit is eligible. 17.5 is a notwithstanding provision. So even though it is very much essential for your business, you are not given the benefit of input tax credit. That is once again reiterated in Class D. You may be using that particular immovable property in your business or in furtherance of your business. Still, the credit will not be given to you. For what? Goods or services or both received by a taxable person for construction of an immovable property other than plant or machinery. Here the word used is plant or machinery, which is very crucial. Now, go to the next slide. The word plant and machinery is explained. There is a definition for the phrase plant and machinery. Plant and machinery means apparatus, equipment, machinery fixed to earth by foundation or structural support that are used for making outward supply of goods or services or both, and includes such foundation and structural support, but excludes land, building or any civil structure, telecommunication tower and pipelines laid outside the factory. So a building, however important it is for a particular factory, will not qualify as a plant and machinery. So the word plant and machinery is used only in class C dealing with host contract, whereas the word plant or machinery is used in class D. So Supreme Court interpreted this is a conscious use of the words. So this definition of plant and machinery will apply only for class C. It will not apply to class D. So whenever credit eligibility is examined with reference to class D, if the particular building can be considered as a plant, a building cannot be considered as a plant and machinery because plant and machinery definition we have, which specifically excludes a building. But a building may be considered as a plant. The word used is plant or machinery. So if a building can be considered as a plant, for that the Supreme Court has referred to various previous decisions, but has not given its finding. When a building can be considered as a plant, the Supreme Court has not answered that question. They remanded the matter back to the High Court to decide on a case-to-case basis whether a cinema theater, can it be considered as a plant? A hotel, can it be considered as a plant? A warehouse or a shopping mall can be considered as a plant or not? This question was left open by the Supreme Court. So actually the Supreme Court should have gone into that aspect also and laid down the law. It would have been better, but they left it open. Now, what the legislature has done, they argued the plant or machinery, it's only a drafting mistake. It cannot be given a different meaning or should be read as, and all those arguments have been taken, but Supreme Court did not agree. Now they said this litigation is going on for 4-5 years. If at all it was a mistake, you could have amended it earlier. Till now, you have not amended it. So legislature has consciously used a different word in the statute. So now they are making a retrospective amendment by replacing plant and machinery in class D also. Instead of plant or machinery, it will become plant and machinery with effect from 1/7/2017. So to determine the credit eligibility under class D also, the particular immovable property should be in the nature of plant and machinery. Your building cannot be considered as a plant and machinery as per the explanation appended to section 17(5). So this is what they have done. But the question remains, is it the end of the road? Has the Supreme Court judgment has been completely overturned by this retrospective amendment? On the one hand, this retrospective amendment itself is very, very bad in taxation law, especially in indirect taxation law. Several times our Prime Minister and Finance Ministers have spoken that we will not do any retrospective amendment. But unfortunately, in every budget, we see various retrospective amendments, both if it is in favor of a taxpayer to remove an anomaly, to clarify a doubt, it is always welcome. But a retrospective amendment of this nature to overcome a Supreme Court decision having great ramifications across the country, it does not augur well for the taxpaying community. But still, the road is not completely closed. Kindly go to the next slide. See, this is para 32 of the Safari Retreat judgment. I'll just read it. Class D of section 17(5) is different from class C in various aspects. Class D seeks to exclude from the purview of subsection 1 of section 16 and 18 goods or services or both received by a taxable person to construct an immovable property on his own account. There are two exceptions in class D to the exclusion from ITC provided in the first part of class D. The first exception is where the goods or services or both are received by a taxable person to construct an immovable property consisting of plant or machinery. That is, 17D restriction will not apply if the immovable property is in the nature of a plant or in the nature of a machinery. This they have overcome. It is not plant or machinery, it is plant and machinery. The second exception is where goods and services or both are received by a taxable person for construction of an immovable property made not on his own account. So if the construction is not for own account, the restriction will not apply. That is how class D has been worded. We will see the class D once again in the next slide also. Now, the Supreme Court goes on. It says, construction is said to be on a taxable person's own account when it is made for his personal use and not for service. Suppose I am a manufacturing unit. I construct my factory building. It is on my own account. that is on his own account, or it is to be used by the person constructing as a setting in which the business is carried out. I'm a chartered accountant. I need an office. I need an office building. I construct an office. I use it for my own office. It is on own account. The next sentence is very crucial. However, construction cannot said to be on taxable person's own account if it is intended to be sold or given on lease or license. This is an emphatic finding by the Supreme Court. So, giving a building on rent, on lease, is not own account, because I'm not going to use that building for my own business. My business may be renting, but the building is given on rent to somebody else who is going to use it for his business. So, categorically, the Supreme Court has said leasing and licensing will not be considered as using the building for own account. So with this, if we go back to class D, go to the next slide. Go to class D. The restriction reads as goods or services or both received by a taxable person for construction of an immovable property on his own account. So the restriction itself is only when a building is constructed for own account. What is own account? Supreme Court has said renting, leasing, licensing is not own account. That part of the judgment still remains. So, whenever a mall is constructed for lending out to other people, whenever any warehouse building is constructed and leased out to another various other parties, wherever this renting element is involved, it is not own account as held by the Supreme Court. Still, that credit will be eligible. So, the effect of this retrospective amendment will only be whoever wants to claim ITC for a building which is used on his own account. Suppose I'm a manufacturer, I construct my factory building, I procure goods and services, and then whether I am eligible to take the credit or not, it is own account, credit is not eligible. But if that building qualifies as a plant and machinery, I will be able to take the credit. But the definition of plant and machinery says buildings are not included. So this retrospective amendment will have an impact only wherever credit is claimed in respect of plant and machinery or building or immovable property on own account, and giving it on rent and lease is not on own account. So majority of the cases, the buildings are given on rent or lease, like shopping mall, Kalyan Mandap, all those other things. So even after this retrospective amendment, in my humble view, credit will still be eligible. This may be a very bold proposition for whatever I say. In fact, when I attempted to talk to some people, they were not willing to accept this proposition. Some people still feel that the entire judgment has been overcome. Anyway, it's a debate which is opened up. So I feel the restriction under class D has got only two and one. Whenever credit is claimed for something, an immobile property used for own account, and again when and what is own account is already held by the Supreme Court, and renting, leasing is not on own account. So this is how this retrospective amendment. So definitely the story is not over. We may have to go through another round of litigation right up to the Supreme Court in the next 10 years to get the issue resolved. And that is how law evolves over a period of time. So I think of all the amendments relating to GST, this is the one which is very important and which will have a long-term implication. And the interesting thing about the budget, earlier days when it was excise and customs and all, budget used to be very, very interesting as far as excise and customs and service tax is concerned. But now the role of the parliament in GST has been taken over by the GST council meeting. So whenever there is a GST council meeting, it is like a mini budget. We get lot of notifications. Very recently, we had the 55th meeting, followed by lot of notifications and circulars. So there are not much of amendments under GST through the budget, because it is always through the GST council meeting, and whatever decisions have already been taken in the GST council meeting, they are implemented through these particular amendments. So with this, I think I have covered most of the amendments, important amendments relating to GST, supplementing whatever Aditya Reddy has said. And with this, I think we can move on to the question and answer session. The slide can be closed.
Thank you, Natarajan. It was and Aditya. It was a very exhaustive session, and the twist to the tail with respect to safari retreats made it all the more interesting. I'm sure everyone has a lot of questions. We'll start with questions on customs. We'll go in the logical order if possible. The questions that Hari's piece threw up. People will be waiting with questions on that, and thereafter we will go to GST. Any questions? Would you like to put up your hand in the chat box?
They can unmute themselves and ask the question, I think. Yes, that is possible. Anybody wants, they can unmute themselves and ask.
Okay, in the meanwhile, let me ask for one of the questions, Hari, if I would like you to clarify is on what happens to payment under protest. Because after the ITC judgment, there has been a view taken that so far as protest payment is concerned, that is not something that will be where you need to file an appeal against the assessment made under protest. That itself amounts to a challenge to the assessment.
Yes, ma'am. So
Yeah.
in cases of payments under protest, the proper officer will necessarily have to pass a speaking order to vacate the protest. So unless and until the protest is vacated, either way, either the officer accepts the stand of the assessee, or the officer says, no, what I have done is correct, I have reassessed it correctly, and therefore I confirm my reassessment by way of a speaking order. Either way, he has to vacate the protest, and then the assessee would have to then challenge that speaking order in appeal, get the order reversed, and then file a refund claim. Therefore, the refund claim will only begin to run after the speaking order is passed by the officer vacating the protest, and after that speaking order is challenged by way of filing an appeal and set aside in favor of the assessee. Therefore, that position will still remain, and ITC judgment will not apply in cases where duty is paid under protest, madam. You are perfectly right.
So now this amendment that has come in, will it have any implications on the protest payments which have to be vacated by a speaking order?
So, madam, no change as far as that is concerned. So, anyway, the new provision which has come in, 18A, will only cover cases where, madam, the proper officer has not reassessed the bill of entry under section 17. So, where, madam, the importer has filed the bill of entry and inadvertently omitted to claim the benefit of a notification, or has wrongly declared the currency or the value of the goods, a clerical error or some other bona fide error, then such cases are only covered where the assessee can himself revise his entry under section 18A, and then that revision will be construed to be a self-assessment, consequent to which he can file a refund claim directly. So this is the provision cases where the proper officer has not reassessed the bill of entry under section 17. Those cases would be covered by the newly introduced section 18A, and this right is independent of or in addition to section 149 of the Customs Act.
Thank you.
Thank you, ma'am.
So, would you say that section you can't for protest payment you cannot resort to 149?
For protest
No.
payments, madam, what happened is since the officer has already reassessed, see, generally we pay a duty under protest. When the officer has reassessed the bill of entry and he says, no, it is not 10%, it is 20%, you have to pay 20% duty. So since I require the goods urgently, I pay the differential duty under protest and I clear the goods. So the officer has already reassessed the bill of entry. So that reassessed bill of entry under section 17(5), officer has to pass an order to vacate the protest. So already my avenue is left open because the officer is not yet discharged his responsibility or his part of the duty in vacating the protest that I have lodged. So 149 cases, madam, will not in my opinion, maybe others may have different opinion, but my opinion is that 149 section cannot be applied to cases where duty is paid under protest, because the importer exporter already has an avenue of agitating his rights by getting a speaking order. So if the officer is vacating the protest in favor of the assessee, saying that no, my reassessment was wrong, I am correcting it back, then no problem, straight away refund claim. Officer is saying no, my act of reassessment is right and you have paid duty which I am now correctly appropriating, then I have still a right to file an appeal against the speaking order and get it set aside. Just like an order original is passed, speaking order is passed, so it's set aside. So 149, in my opinion, madam, may not cover cases where duty is paid under protest, because already I have a right, independent right of getting a speaking order and challenging it.
Thank you, Hari.
Thank
Any more questions on customs, or shall we move to GST? I think GST amendments in GST.
I have one question, ma'am, that is related to both GST and customs for Hari.
Yes, sir.
Because the GST, like I mentioned, GST proposals mention a track and tracing mechanism. I think in customs you already have something called an electronic seal to ensure that there is no tampering of goods in transit for export, etc. How effective is that, Hari? Has it been helpful in preventing evasion, etc.?
See, for as far as exports is concerned, there is a circular issued where one-time self-sealing permission is given to exporters on an application made to the Commissioner of Customs. So the self-sealing permission has worked well by and large, and generally it is given only to those exporters who don't have any past antecedent, who don't have any pending customs cases or show cause notices or prosecution. And based on verification, they give this one-time permission, which is renewed periodically. So customs, by and large, this has been implemented properly because I can stuff my consignment or goods in my factory in the container, affix a one-time seal, and send it to the port for export. So it's a trade facilitation measure because the government wants to believe the exporter that he is doing it correctly. But by and large, it has worked correctly. Of course, there have been cases where red sanders and other contraband items have been stuffed in this container. But by and large, it has worked well. Self-sealing procedure has worked well. There's no problem in customs. I don't know whether that is the same thing which is contemplated in the GST. I'm not sure about that. But customs, the self-sealing provision, where the customs, the exporter himself affixes the one-time seal through his agent, has worked reasonably well. GST, I'm not sure what is the modus operandi that is proposed now for that. Probably Natarajan sir or somebody who can explain.
Yeah, maybe we have to wait. Only a
We have to wait for the procedures.
So we have to wait. And this is going to be something different from that sealing. Sealing is you just seal the container and take it to the port and export it. So
This for the
goods
goods.
are not diverted. Here, I think it is going to be something like affixing a QR code on a cigarette
For the
packet.
goods.
On the goods. So earlier we had this physical control. An officer will be posted in the factory. So all removal will be under the physical control of the officer. And slowly we are going back to that era in a digital mode through this thing. But anyway, the evasion, there are certain commodities which are evasion prone, and government is trying everything possible to control it. So
sir, under earlier central excise, there was this for pan masala, gutka, packaging machine rules were there.
Yes.
Where irrespective of the actual units manufactured.
Depending on the capacity of the machine.
So maybe similarly,
Yes, so there is a provision to that effect
also.
Fixing the amount based on the capacity of the machine.
Capacity machine.
Provided for under 140 ATA.
So when Natarajan was speaking on the judgment of the Honorable Supreme Court in Safari Retreats, and he was saying that the entire judgment has not exactly been set at naught by the budgetary amendment which is going to come, which has been done. I agree with him, and I had just a thought, that we could perhaps have a separate session on the Safari Retreats judgment itself by way in the mode of a Pattimandram, where there is a line of thought that the entire judgment has been set at naught. But there's yet another line of thought, just as Mr. Natarajan has said, that entire judgment has not been set at naught. There can be still avenues of challenge. So I think that can be done. And I agree with him that the entire judgment has not yet been set at naught. We can definitely look into the amendment as well as the judgment to find out the areas where we can still litigate and come to another set of, a third line of thought, perhaps. So that is my just an addition to what Mr. Natarajan was saying, that could be done in the future, because this particular session cannot cover the entirety. So that could be done, subject to what the secretary says. And Mr. Gokul Kishore is here, I think. Please, you can also pose any questions that you have. And Mr. Krishnanand, what is your thought on the customs budgetary changes? Mr. Krishnanand has just come on screen. He can also say something.
Mute sir, mute irking sir, Krishan sir, mute irking.
Yeah. Frankly speaking, I have not gone through what changes have taken place because I'm in Kumbh Mela right now. I'm on my way back. So I don't think there are many major changes as far as customs is concerned. Am I audible?
Yes.
Yes.
Yes, sir.
Yeah. So I don't think there are many major changes as far as customs is concerned, except for maybe the warehousing provisions, which I just glanced through in the notes that we got in the other WhatsApp groups. But no major changes, of course, in customs right now.
Settlement commission also.
Settlement commission has gone for a 6. It was actually what somebody commented yesterday on the group that, a place for retirement is now over for them. Retire means retire forever. That's all. No more settlement commission. But what will happen to the cases that are pending for ages together now? That's the big question. They are not bothered. I have a case in Chennai, and these people, the case actually originated from Kerala. The case was posted at Chennai, and these guys wanted to take a retreat to go to Kerala to have fun and held the meeting in Kerala. I booked my tickets to go to Kerala all the way, and I said, sir, the seat of the settlement commission is Chennai, and why don't you have the hearing here? Why do you want the client to waste money or me to waste time and money traveling all the way to Kerala? Then somebody from the settlement registry said, they just want to travel to Kerala and have a look at Kerala around. This is not the way things are done. So anyway, let's see what happens.
I have a doubt in this.
Yeah.
See, Hari was mentioning that there is one interim board that is replacing the settlement commission. What could be the functions of that board? I mean, settlement commission, are the powers going to get transferred, or what could be the function of that board?
Yes. Hereafter, the pending cases will be taken care by the interim board for
Interim board.
settlement. Exactly. For the pending
So,
cases.
Effectively, settlement commission has not been completely gone. Has not completely
For the
gone.
pending cases, it's there. For the future cases, now it is abolished. Similar to Income Tax Act.
The powers of the settlement commission will now be exercised by the interim board.
Now,
After this provision
the
is come
settlement
into-
That's what I'm
commission,
saying.
now the settlement commission has got a separate infrastructure. They have a building, they have their own staff, members are appointed from eligible, all those things. Now it will not be like that. It will just like our advanced ruling authority.
Yes.
Advanced ruling
authority is not a separate
revisionary
establishment. The officers are nominated, and with the existing infrastructure, they work. So like that, a chief commissioner level officers, 3 of them will be nominated as board members. With the help of their own staff, they have to deal with the pending applications. That's all.
No, the fact, I think the point is this. Settlement commission now, you have to pay the entire amount of duty and interest before you file an application.
That and all
Now-
will remain.
No. Basically, I'm saying this is the precondition now to file a settlement application, unless there is a dispute in the quantum of duty or accepting or not accepting. And 99% of the cases, there is no dispute about the duty or the interest. You are willing to pay almost the entire quantum of duty. Very few cases where there is a dispute. So they don't want this kind of a full-fledged mechanism and spend this kind of money on these kind of people. And like you said, sitting chief commissioners will constitute, and they can just decide and close the file. Just a matter of closing the file. That's it.
Yes.
Because as long as the government gets the revenue, I think everything is sorted out.
Yes, that seems to be the intention.
Yeah. Mr. Natarajan, by the way, the checkbook is in my office. I asked my boy to deliver it to you, but somehow there was some stopgap. I rushed in for Kumbh Mela suddenly.
No, we can collect it next week. No urgency.
Tomorrow, it will be handed over to you. It's reached me.
Any other questions? Or shall we move to direct tax and then come
No.
back?
Gokarnation sir has got query. Sir, unmute
Sir.
பண்ணுங்க sir.
I have a question, sir. Natarajan sir.
Yes,
Sir,
sir. A
that-
session
that
will not be
on-
complete without a question by Mr. Gokarnesan.
No, the concept of own account interpreted by Supreme Court is not available in the law. If you go to the section 17,
The
subsection.
Supreme Court
The
is the
Supreme
law,
Court
sir.
is law, Article
I agree, sir. I
142.
agree,
Is the
sir.
law.
I agree, sir. I agree, sir. But I come to the question. Here, normally the own account, Supreme Court interpret as it is not, if it is given. But in the Act itself, it says it should not be used, even if it is used for furtherance of business, everything, including this renting is also a furtherance of business only. The question here is, suppose I constructed a mall and give it for rent, means the renting of property by me is also a business only. So when I do that, the explanation, the class D very well said, even if it is used in the course of furtherance of business, that itself is act itself is a prevailing
So we will go step by
importance to
step.
that. Where is a question of personal, where is a question of own account comes here? Own account means, suppose I constructed, I leave it in that, it's only own account. When I construction activity itself is own account. I buy cement, I buy steel, I engage somebody, I construct on my own. That is the own account refers in the act. That's my interpretation. I agree with you. But it has to be seen. What is your opinion on that?
That's what,
So
sir.
one minute, Mr. Natarajan, 1
I
minute
think-
before you answer. Just find out from Mr. Gokarnesan whether he has already purchased the Coimbatore bus stand.
No, sir. No, sir.
Sir, this own account, there is no definition for the word own account in the Act.
Yes. Yes.
So the Supreme Court has interpreted,
Mm.
they said renting is not own account. So whatever has been said by Supreme Court is law of the land, Article 142, it is binding on everybody.
Yes.
So
Yes,
renting
yes.
is not own account. So keeping that in mind, renting is not own account. If you read Class D says goods and services used for construction of immovable property on own account.
Mm.
Even if it is for business, that is where I said I am
Yes.
constructing my own factory building.
Mm.
When it is own account,
Mm.
even though it is for furtherance of my business, credit is not eligible. No
Eligible.
doubt about it.
Yes.
But when I am constructing a building for giving it on rent, it is not own account as held by the Supreme Court. Once it is not on own account, I go out of 17(5)(d) restriction at all. That is how it is.
But still,
Except that this point may come up in the review petition. They may want to have this.
No, yesterday Mr. ASG was telling in some other forum that went to withdraw. And the only
Yeah,
thing is, should not.
Yeah, but this
Why-
aspect, if we talk too much
Review, I
about
think we're not
it,
going
So I
to
request
pursue.
all of you to keep the deliberations of this meeting within to yourself.
yeah, I think so.
Yes,
Yeah.
that's what. And as I was just saying, we'll have a separate session. We'll have a Pattimandram. Gokarnesan can be part of the panel also.
Thank you.
Illa sir, vandurungo sir neenga. So I think we should move on to the direct tax
Yes,
because
time is-
I think Raghavan
Time is
Ramabhadan has
running out,
also
yeah.
joined. Time is running out. So I think we can move on to that.
Now, Mr. Raghavan Rambhadran and Vardhini Karthik will present the direct tax session. The panelists, please start.
A very good afternoon, everyone. So this year's budget in income tax, there is a very, very important announcement that in a week or so, we'll be getting the new direct tax bill. So immediately there was a concern that if the new direct tax bill comes, and it was also said that it is going to be not even half of the existing income tax provisions. It is going to be very simplified. So immediately when they said it is not going to be complex, there was a worry. But later on, when deja vu hit us, when they said that it is going to be a simple tax, then that is where, as advocates, we could heave a sigh of relief. Because we have heard this already in 2017, where GST was said to be a good and simple tax. Now we know what kind of litigation is going on and how we all are flourishing. So with this, I think the fond hope is in income tax also, when it is said to be a simple tax, I'm sure there is going to be some amount of litigation which is going to come up. So life is secure. So we can, I think for this week, we can only trouble us. We can be only worried about the amendments which have already been brought in the present regime. Vardhini and I will be presenting on the topic. Good afternoon, Vardhini. So the way we have planned between Vardhini and I is we have made a slide deck and we'll be presenting it. And some topics I will be taking up, and some topics she will also be taking up. And that doesn't mean that the topic which she has taken up, I will not ask questions, and it happens vice versa. So it's going to be a nice jugalbandi. One thing that I want to caution the audience today is, by no means this session is going to be comprehensive in terms of bringing out the impact of each and every amendment. It is not possible, and it is not useful also. Say, for example, in this budget, in the Finance Act, there have been a lot of amendments with respect to IFSC, which is the GIFT City related amendments. Much of it may not be too relevant for us sitting in this geography. So therefore, we have decided that a few of those amendments which are not very particular, not very relevant to us sitting here, both Vardhini and I decided that we are not going to cover it considering the time which we have been allotted. So we will be proceeding with the slide deck now. I would request Vardhini to, which she has already been doing, we will share the screen. So the first topic, we can go to the slideshow mode if that is convenient.
I'm finding it slightly difficult, sir.
Okay. There's the bottom, you see that slide scale.
No, I'm not able to come into the Zoom network, so I'm finding it quite difficult.
Okay. I'm sorry. So, okay. Then we will proceed with this, but the slide is showing on presumptive taxation. Should I present? Vardhini, can I present?
Please, sir. I'll just stop the share.
So the first topic we are taking up is the presumptive taxation. Which is there. See, one thing we have to keep in mind is, just a second. In this proposed amendment, there is a provision which has been introduced, which says that any non-resident who is engaged in business of providing services or technology in India. So if a non-resident is engaged in a business of providing services or technology in India, and that services relating to setting up of electronic manufacturing facility or anything in that connection, then in that case, he need not go by the normal tax rates. He can pay 25%, he can treat 25% of his total revenue as profits and gains, and on that he can pay tax. I'm sorry, I heard a voice in between. Shall I continue? Okay. So this is what the provision says. Now, the questions that arise here is, when a non-resident, he is engaged in providing service in India. So first of all, he is providing a service in India. Non-resident is providing a service in India. So how do you decide when a service is provided in India, how to determine the locus of a service? If a design is sent from, let us say, a foreign country to India, is it a service provided in India just because it is used for setting it up here? Or should someone actually come here to render that service? So these questions come up because it is not clear from the provision when a service will be said to be provided in India. The other provision, the difficulty that also arises is, we have section 44DA that is also there, which is also part of the presumptive taxation period. This particular provision, which you have on the screen, this is non-obstante 28 to 43. That means it is not non-obstante 44DA. 44DA says, whenever a non-resident has a permanent establishment in India, and through the permanent establishment, he earns a royalty income or fee for technical services, so royalty or FTS, then there is a presumptive taxation regime for him. So the conditions there is, he should have a permanent establishment in India. And when I say permanent establishment, it is not just a fixed place PE. That permanent establishment can be a service PE as well. So basically that person has a permanent establishment in India and earns income through royalty or FTS. then he is going to be taxed under 44DA. But this provision is not talking about permanent establishment, but says he is providing service in India. And it is not just saying providing service in India, it also says engaged in providing service in India. When it says engaged in the business of providing service in India, that means the word engaged denotes there is some amount of regularity and there is some amount of continuity. So whenever it says engaged in providing service in India, that means that there is some regularity and continuity in this activity. So therefore, it may constitute PE. So only way we can reconcile 44DA with this particular provision is whenever the person is providing service in India, but that is not in the nature of fee for technical service, or that is not in the nature of royalty, or that is not constituting a permanent establishment in India, only in that case, this provision will kick in. If it constitutes a permanent establishment in India and that income also acquires the character of fee for technical service or royalty, then it will be taxed under 44DA only. This is how we reconcile this, and this comes from assessment year 26-27 onwards. Here again, this is a compulsory provision. So it is not like people can choose this or something else, because it is non-obstante entirety of the chapter relating to PGBP. And again, what is meant by providing service in India? This is what I was highlighting. Should it be actual rendition of service? And what is meant by actual rendition of service? If a service starts from abroad and then it is consummated here, then whether it is rendered in India, whether in India means wholly in India or partly in India, that is also not clear. Engaged, as I said, that denotes permanency and continuity. The next aspect is there is an amendment in section 9 which deals with significant economic presence. So basically they have harmonized it with the business connection concept. The point here is, if we see section 9 which talks about income deemed to occur or arise in India, we have the test like it has to be a business connection, or a property should be located here, or from an income should be derived out of an asset or source in India. This is fine. No, a deeming fiction, there is an explanation in section 9.1 which says that if a non-resident only purchases goods in India for the purpose of export out of India, then the deeming fiction that the income is deemed to occur or arise in India will not apply for that income. So for that activity. So purchase of goods in India by a non-resident only for the export, then it is not deemed to occur or arise in India. But there is in section 9 itself, there is a concept of significant economic presence, and it says that that constitutes a business connection in India. Now, significant economic presence definition talks about transaction in goods also. It talks about property, various things, but it also talks about transaction in goods. There it says that if a non-resident will have a significant economic presence if he purchases goods in India. So therefore, there is a definite conflict between explanation 1 and explanation 2A. Explanation 1 says if the activity of the non-resident in India is confined only to purchase of goods for export, then he is not deemed to income, such income is not deemed to accrue or arise in India. But when we go to the significant economic presence definition and through explanation 2A, it says that if the non-resident is purchasing goods here in India, then he will fall within the ambit of significant economic presence. Therefore, there is a business connection. Therefore, there is a conflict between explanation 1 and explanation 2A that has been addressed in this amendment. This amendment says transaction of purchase of goods in India for the purpose of export will not constitute significant economic presence. So therefore, there is no significant economic presence. Therefore, there is no business connection. Therefore, the income will not deem to accrue or arise in India. So the conflict between explanation 1 and 2A now has been resolved. Though so much has been said about this section, this will be relevant only with non-treaty countries, because wherever we have treaty countries, we have the permanent establishment concept already inbuilt in the double taxation avoidance agreement, and that will take precedence, which we all know. That is why already we have the significant economic presence not being a popular concept already, because this becomes relevant only with non-treaty countries. Wherever it is a treaty country, we still go by the brick and mortar test. But here with a non-treaty country, this explanation will really help. If a non-resident from a non-treaty country purchases goods in India only for the purpose of export out of India, then he does not have, his income will not be deemed to accrue or arise in India. Now we will move on to an amendment to the definition of capital asset. This is with respect to alternate investment funds. and Cat 1. Vardhini, do you want to take this up, or how do you want to proceed?
I'll be making some submissions only on this AAF in respect to IFSC.
Yes, you can only deal with that.
I'll be dealing only with that.
Yes. As it comes. Vardhini, now or as it comes?
So if you want, I can do it now also. I can do it along with that slide. I'll just make a little bit of details along with that.
So we will reserve this later. So we will deal with this later. Now, the other amendment is relating to ULIP. Now, with respect to ULIPs, the maturity amount which we get out of the ULIP, we have section 1010D. The concept here is wherever any maturity benefit which we receive from ULIP, if it is exempt under 1010D, fine. If it is not exempt under 1010D, ideally it should be treated as capital asset, which means that that maturity amount will be taxed as capital gains. But the difficulty that arose in this is, if you see the provision, particularly 1010D, 1010D has 4 conditions when it will be exempt, etc. Then it has a few provisos. The condition talks about the annual premium should not exceed 10% of the total maturity amount, etc. Proviso says that the annual premium in a year should not exceed 2.5 lakhs. Now, the anomaly which exists as on date is ULIPs, if it is not satisfying the condition of 2.5 lakhs, that is, in a year, the annual premium should be less than 2.5 lakhs. If the annual premium is more than 2.5 lakhs, the benefit of 1010D is not applicable. In that case, the provision says that it will be treated as a capital asset and that the maturity amount will be taxed as capital gain. No difficulty. So one condition, namely 2.5 lakhs condition, is not satisfied. It will be treated as capital gains, capital asset. Therefore, the categorization is as capital gains, no difficulty. On the other hand, if the ULIP, the maturity amount, is not eligible for 1010D exemption because it crosses the 10% threshold, 10% of the total premium, if sort of maturity amount, if the premium crosses 10% of the maturity amount, then also 1010D benefit is not applicable. But if 1010D benefit is denied because of the 10% rule, then it will not be a capital asset. It will be taxed as income from other sources. See the anomaly. Same 1010D benefit, 1010D exemption not eligible because we cross the 2.5 lakh threshold, then it will be taxed as capital gain. 1010D benefit not eligible, we cross the 10% threshold, then it will be taxed as other sources. Makes no sense. Therefore, now what the amendment has done is they have ironed this difference out. They don't see which condition. They say so long as 1010D benefit of exemption benefit is denied, then it will always be treated as capital asset. There is no scope to treat it as income from other sources. So this is an amendment relating to categorization, and they have now clearly clarified or categorized it as capital gains and not as income from other sources. This is an important amendment with respect to ULIP. Now the next one is with respect to amalgamation. The memorandum says that there is something called evergreening of losses. And this amendment is aimed at stopping the evergreening of losses. So what do they mean by that? My reading of this provision is, if any of you are already planning for any amalgamation, you should get it done before 31st March 2025. What happens is sometimes amalgamation is adopted as a method to save taxes. Suppose there is a loss-making company. The company has made losses and periodically, repeatedly, they have made losses. And let us say there is a carry forward loss for 7 years. Law allows it to be carried forward for 8 years. So 7 years loss is there. Now there is another profit-making company. The profit-making company, usually what they do is they take over this loss-making company. What happens is the losses of this company, that is the loss-making company, that will be carried into the profit-making company, which is the amalgamated company. In the new company, this loss will be carried forward. The law as it existed prior said this 8-year carry forward will start as a fresh term from the date of amalgamation. So already 7 years, it was a carry forward loss in the old company. Doesn't matter. Once an amalgamation happens, this will be carried forward for another 8 years, is what the earlier provision said. This, the legislature saw it as evergreening the losses. They say that already 7 years is over. Law says we can carry it forward for 8 years. Why to give another 8 years? So what the new amendment says is it is not available for another 8 years. Whatever is the unexpired term for the losses, only for that unexpired term you can carry it forward. So if it is for 5 years in the old company, amalgamation happens today, then the loss can be carried forward for another 3 years only. If it is 7 years in the old company, amalgamation happens today, it can be carried forward for only 1 year. Earlier, it was 7 plus 8, 15. Then if it was 5, 5 plus 8, 13. But now it is in total 8 only. And just because there is an amalgamation, we cannot reset the clock and start the 8 years once again. This is what this provision says. This is effective for all amalgamations affected from 1/4/2005 and effective from the assessment year 26/27. But because it says amalgamations from 1/4/25, this becomes very, very critical and immediate. Now, the next one is 206C 1H. This is a popular one which we all have discussed a couple of years back also, where it says wherever there is a transaction in goods and there was a threshold above 50 lakhs, etc., then there is a TCS applicability on that under 206C 1H. Now, what happens is there is also a provision 194Q which also deals with sale of goods where there is a TDS liability, tax deducted source. 206C 1H deals with TCS liability. When this was brought in, what happened was deductor was also deducting, the person who is supplying, he was also collecting, both were depositing tax. Why at both ends was the question. Then the law said that when both are applicable, 194Q will take precedence and not 206C 1H. Therefore, wherever there is a deduction happening, then tax need not be collected. But how will the supplier know if the deductor is going to deduct when he is making the payment? So therefore, to be cautious, everyone collected, everyone deducted. So for the same transaction, both TCS was also getting applicable, TDS was also getting applicable. So basically, the government was benefiting at both ends, literally. Now what happened is they realized this and they wanted to rationalize this. Already they had said 194Q will take precedence. Therefore, what they have done is they have made 206C 1H not applicable wherever 194Q deduction is taking place. So therefore, in effect, 206C 1H is not applicable. 194Q is only applicable. Now, therefore, it is only on one side. Now, this is with respect to the higher TDS, etc. For basically with respect to non-filers. So this was again a problem which was happening wherever the person is not filing the tax, then for him, if we are transacting with them, then we have to deduct TDS at a higher rate or we have to collect TDS at a higher rate. There is a normal rate, then there is a higher rate when we are dealing with non-filers. But at the time when I deal with them, like what we talk about our 2A, 3B mismatch, how will I know if that person is a filer or non-filer? There is no mechanism for me to know. This is what when we said. Then they said that no, we have a fantastic portal. Portal gives the details. If you go into the portal, you will know if it is if that person is paying or not. There is an inside portal. So you go into the portal, your problems are solved. This was what was said, but it was not happily working. There was a problem. Now they have realized that there is a problem. So what they have done is they have removed this distinction, whether you are dealing with a filer or non-filer. Non-filer means higher rate of TDS or TCS. Now this has been removed. These provisions have been omitted with effect from 1/4/2025. This is also actually a very welcome amendment. Now, this decriminalization of, when I say TCS, you read it as non-collection of tax collected at source. This is not to do anything to do with TCS. So it is not decriminalization of TCS. So collection of tax collected at source and non-deposit. So this is always a serious offense. Like TDS also, we deduct and we don't deposit, it's a serious offense. Now, what this provision says is, if you collect and not deposited, it used to be a very serious offense. But now what we will do is, we will give you some breather. Every month you have to collect and deposit. And every quarter you have to file the statement. So every month you collect, you don't deposit, but at least you deposit before you file the quarterly statement, then this will not be treated as an offense. But if you cross the time for filing the statement, then it will be treated as an offense. Therefore, there is a breather given for 2 months that you you collect in this month, not deposit for next month, but at least before the time limit for filing the quarterly statement, if you deposit, then it is not an offense. This provision has been brought in. Earlier it was there with TDS in 276B. Now it has been brought in 276BB also. 276B was with respect to TDS. 276BB is with respect to TCS. It has been brought with effect from 1st April 2025. Now, this transfer pricing is also a very, very important amendment. It says block assessment. We have said block assessment because the memorandum uses the term block assessment. The provision does not use the word block assessment. It is not like your 158 series, 158B series. It is not like that. This is why they say block assessment is, suppose for a period where the transfer pricing officer orders, says that a transfer pricing adjustment needs to be made, etc. Then benchmarking study is done, etc. So you determine based on any of the methods, you determine that this is the arm's length price. If you have determined for year 0, then what can happen is the assessee can apply to the officer to adopt the same arm's length price for the next 2 consecutive previous years also. Because this study has been done and year on year transactions remaining the same, similar transactions, so we need not redo the same thing. Therefore, the option is given to the assessee to say that since the transactions are similar, we will file an option. Once that option is filed and that is validated by the TPO, for the next 2 consecutive assessment years also, the same arm's length price can be adopted. Initially, I had a doubt whether they are talking about arm's length price or the method for determination of arm's length price, but the provision is extremely clear. They are talking not about the method, they are talking about the arm's length price itself. So this is what is clear from the provision. So this seemed to be a welcome amendment because let us say in year 0, the profit margin is determined as 15% and the transfer TP adjustments are being made. Then in the next year, my profit margin may be 20%. But what I can do is I can plan it out and then I can opt for this. Say that I want to adopt the same transfer arm's length price for the previous year. You give this option for me for the next 2 years. So fine. So I thought then the officer will give 15% irrespective of the actual arm's length price for the subsequent period. And I will follow the same 15% for the next year also. The 3rd year, it may even come down to 10, but still since I have opted, I have to go with 15. This is what I thought. But as we read the provision in deep and go to the further provisions in this amendment, it says for the validation, the assessing officer can again conduct such inquiry and he will redetermine. The transfer pricing officer will redetermine the price and he will say whether the price, whether the same price can be continued or not. So in effect, it is not making much of any difference. Though we can opt for the same arm's length price, just because you opt doesn't mean that the officer will give it to you. It seems the officer can still say, you opted, I will not give, I will do a study, and then I will say what you have to opt for or what you have to get as arm's length price. This is how the provision comes in. If this is the case, then it takes the whole shine out of this whole thing. Had it been an approval without verification, it would have been very assessee friendly. But now I will opt for it, but the officer will still doubt that and he can still say what I should adopt. Then I don't see it is helping one bit in trade facilitation. There are some extension of dates with respect to this. IFSC related, I think Vardhini will take care. Other things are already here. There is nothing much to speak about on those. The other one is relating to virtual digital asset. You know that a lot of regulations have been brought around in India with respect to virtual digital asset and separate rates of taxation and denial of set of benefits. So many things have been done in the budgets in the past. So all these cryptocurrencies, etc., have been treated as a separate class already. Now, what this amendment does is it has brought in a specific declaration mechanism. There is a disclosure requirement. It says that whatever virtual digital asset you had whatever statements are there, you have to give it, file it with the department. Now, we do not know exactly each of those, like what is the statement to be filed, etc. Rules are yet to come. But one thing that is quite clear is it is not just the taxation, but the government also wants to know exactly what each person has transacted in the past or what they hold as on date with respect to virtual digital asset. So these kind of like a foreign asset, whenever you have to file separate returns. It appears for virtual digital asset also, you have to file statements disclosing your holding with respect to these virtual digital asset. And when I say virtual digital asset, it includes NFTs also. Any kind of cryptocurrency. So the next important topic we move on to is the rates of income tax. I request Vardhini to take on this topic.
Actually, the budget started with the fact that Goddess Lakshmi has come to the doors of the middle class population. But there is a catch in that particular slab also. If it just says that 12 lakhs plus 75,000 would be the standard deduction, then they are not liable to tax. In the sense that 4 lakhs to 8 lakhs, it comes to 20,000. 8 lakhs to 12 lakhs come to about 40,000. 20 plus 40, 60,000, it is a rebate given under 87A. This 60,000 will be the benefit that will be given for the 12 lakh slab. Whereas if a person earns 13 lakhs, then the amount that he may have to pay is 66,300. So it is just a catch over there. It is very important that any person has to come within the 12 lakh plus 75,000 as a standard deduction if they are going under the new regime. There are two regimes that is available. One is the old regime. The second one is the new regime. I think the pattern of the budget is more, it just wants the population to shift on to the new regime. But it is very important from our side to see which is feasible. Once you go to the new regime, it is not possible to come back to the old regime at all. Old regime is a case wherein you can claim deduction under ATG, then the deductions under the house loan and other deductions. And also we can claim deduction under the medical insurance. So basic deductions are all available. All those deductions are available only under the old regime. If we move on to the new regime, then it is not possible to come back to that old regime at all. So it is very important that it's a key that everyone has to make a calculation as to which would fit in, whether they can go under the old regime or in the new regime. Just because with the 87A rebate alone, it is not possible for us to calculate whether it is beneficial for the middle class population or not. So the next slide, sir. Next one, sir.
One part, Vardhini, I just want to add that as you rightly said, this is only in the new regime. Now what we have is there is a old new regime slab and this is a new regime slab. And this is different from the old regime.
Yes.
There is a old regime, this is usual rate. Now with this slab, with this 25%, etc. coming in, then 4 lakh difference. The earlier one has become old new regime. This is only the new regime.
And the old regime still has the 3 lakh to 5 lakh as a net, and then 5 to 7 lakhs as a net. So it is better to make a calculation because under the old regime alone, you have the deductions that are available.
Correct. 6A benefits have to be factored.
And I think it is more for them to make sure the population shift from old regime to the new regime so that all these deductions and other sections become, it is not possible for them to utilize at a later point of time. So that has to be seen in a clear note. Then the next part of the PPT is about the measures to promote investment and employment. In that category, deemed dividend. Generally, a deemed dividend, this has been introduced with regard to the IFSC. I'll just give it's with a disclaimer, I just start with IFSC because I've just read it in the last couple of hours and I'm just trying to give as to what it is. IFSC is International Financial Service Center. This actually came into play with regard to the GIFT City. GIFT City is Gujarat International Finance Technology City. This has been built within the Sabarmati River, wherein they wanted to give more and more impact to this GIFT City. They wanted to compete with the economies in Dubai and Singapore, wherein they offer these kind of services. So IFSC is not only with regard to banking channels, it is also with regard to AAF, which talks about alternate international fund, then also mutual funds. Then there is also shipping and aircraft structures that is also brought inside this IFSC. So there are companies like Big Four, EY, PwC, Deloitte. Then there are also McKinsey, company like McKinsey. Then there are also cargo shipping companies. All these companies are being targeted so that there is a lot of investment that is brought into the country. So this 2 clause 22, what has happened is that the concept of deemed dividend, exclusion of advance or loan between two group entities, one of the two group being the finance company, another being the parent or the principal entity, is just for a fact that in case if there had been any borrowing from the corporate treasury center outside India, then they wanted to make sure that the deemed dividend concept will not apply to these cases. This is the reason behind bringing up this. I think they want to mobilize more and more international investments inside the GIFT City. And this is with effect from 1/4/2025. Definitely, it's a welcome change.
So you are saying focus is not just Bihar.
Yes, yes. They wanted to bring in the future 9A3. This is also somewhat related to IFSC. It talks about eligible investment fund. There are categories for eligible investment fund. The first is that the fund is not a person resident in India. 2, the fund is a resident of India with of a country or a specified territory with which an agreement referred to in section 90 has been entered into. And C, the aggregate participation or investment in the fund directly or indirectly by person resident in India does not exceed 5%. This has been majorly, this is a 9A is an exception to business connection. There are fund managers who are placed in India, but these investment funds happen outside India by other people, and there might be only about 5% of the participation from residents in India. These, just because the fund manager is located within the scope of India, they cannot bring it under the concept of business connection. That is why the section 9A was actually introduced. So this is also more in line to bring in funds for GIFT City. GIFT City is the word that has to be seen. Next slide, sir. So next slide, sir. This is also the 4E, 10-4E, 4F. 4E talks about foreign portfolio investor being a unit of an IFSC. 4F talks about any income of any non-resident by way of royalty or interest on account of aircraft or ship in a previous year paid by a unit of IFSC. 10-4H also talks about exemption to non-resident or a unit of IFSC engaged in aircraft leasing or on capital gains on transfer of equity share of domestic companies being units of IFSC engaged in aircraft leasing. So they wanted to bring in all kind of investments within the GIFT City. It is not only IFSC, that is things dealing in the banking transaction like a mutual fund or some kind of banks. Even when I was just having a look at the GIFT City, I could see that Punjab National Bank, Bank of Baroda, all have their place in the GIFT City. It is more because all these, they are exempted from tax. And more importantly, they want other country people to make an investment, more or less the non-residents to make an investment in the GIFT City in the Indian banks. So these are things that are on a futuristic view, they want to bring in line with Singapore so that a lot of investments gets pulled in. So next slide. 10-12BA. This is generally the national pension, the scheme was available. Now it has been extended to minor children. So this is a new 80CCD benefit that has been extended to NPS Vatsalaya accounts. So a lot of people can make an investment on their minor children, and the deduction up to 50,000 can be used. And in case if there is a withdrawal, which is less than 25%, then tax will not be charged. Whereas if it has been a withdrawal which is more than the 25%, then tax will be deducted. And in case if the minor, if there is a death of the minor, then it is not chargeable to income tax. But these sections, these tax benefits will be available only if you go under the old regime. It is not available if you go under the new regime. So it is very important whenever we make the personal income tax planning, it is very important to make a clause as to whether new regime is beneficial or the old regime, and whether you want to continue with the deductions that are available under the old regime. It is something that has to be noted. So next slide. Simplification and rationalization. In that slide, we would be dealing with the TDS rates. So as you have seen that the interest with regard to the senior citizen, it was 50,000. Earlier threshold limit, it has been increased to 1 lakh. Then others, it has been 40,000. Now it has been increased to 50,000. The next slide, sir. Initially, the professional fees wherein the threshold limit was 30,000. Now it has been increased to 50,000. So it's a good change. And with regard to the rent, it is 2,40,000. And now the present one is 50,000 per month or part of a month. So, sir, I think you can throw in some suggestions, because it's not very clear as to whether the 6 lakhs can be the limit that can be for 194I. Or is it part of a month? Then there must be some clarification on that.
Yes, the finance minister's speech also said 6 lakhs. So it was said. So therefore, it is only here reduced to a monthly denomination, but basically it is 50,000. Basically 6 lakhs a year. That is how it has to be seen. And part of the month is, even if it is 11.5 months only paid, etc., still it is 12 months is what we need to consider. So that's what it means. So that's how I read it.
I felt that if it is more than like 6 lakhs in 12 months, it is going to be 7.2 lakhs. But whereas I have rented it out only for about 7 months, it's still less than 6 lakhs. Whether this benefit will be available, maybe that may be a possible litigation may arise in that kind of a situation. I'm not sure. I was just thinking that this may be a situation wherein litigation may arise, because there is no clarity as to that fact that rupees 50,000 per month or part of a month.
Per month or part of a month. So even if it is part of a month, it is 50,000. It is not 25,000.
Then the enhanced compensation, it has been increased from 2,50,000 to 5 lakhs. Next slide. Charitable trust, I think there had been few amendments. I was under the impression that there is going to be a comprehensive income tax bill. There will not be much amendments, but unfortunately there had been a lot of amendments with regard to the stay provisions in the Income Tax Act, and also with regard to the charitable trust. This is a welcome change, wherein it says if the total income of trust or institution without giving effect to provision of section 11 and 12 does not exceed 5 crore rupees during the 2 previous years from the date of application, the period of 5 years shall be substituted as 10 years. So those trusts which are small trusts wherein the amount is less than 5 crores, then they may not need to go to the exemptions office to go and get it renewed every 5 years. And there is also, you need to make a renewal before 3 years. So those kind of things does not arise now. It has been substituted that they have a charitable trust registration for the next 10 years. This is another good change that has been brought into charitable trust. Earlier, what had happened is that in case if there is an incomplete application, that itself per se is a reason for a violation under 12A 1AC, and it will be rejected. But now they have said that the specific violation as defined in explanation to 12AB in incomplete application under 12A has been omitted. So in case if there is an incomplete application, it may not be a reason for them to make a rejection under the 12A. The next clause is with regard to 13.3. 13.3, what had happened is that earlier, if 50,000 rupees is given by any person as a kind of a contribution towards a charitable trust, then more than 50,000, either 50,000 or 51,000, then that might also be a reason for triggering 13.3 for disallowing the total income of the charitable trust. But now what had happened is that the 50,000 has been changed to 10 lakh rupees. And any relative of any author, founder, this person has been deleted as of now. And it just has any relative of any author, founder, member, trustee, or manager as aforesaid. So the person clause has been taken out so that there can be donations or there can be contributions given by persons to the trust. This is definitely a good move for encouraging the charitable trust.
So basically, this says 50,000 is changed to 1 lakh, and in aggregate for the past year, it has to be 10 lakhs.
10 lakh, yes, yes, that's. Earlier, only the Joint Commissioner had a power to levy penalty under 271C, 271CA, 271D, 271DA, and 271DB. 271D is more on the penalty wherein it has been gotten, wherein there had been a cash transaction, and the penalty will be levied only by the JC, Joint Commissioner of Income Tax. Whereas now what has happened is that they have given this power to the assessing officer. There was also an amendment which says that JC will also include assistant commissioner, additional commissioner. That was also brought in. So additional commissioner, who was a little below rank to the JC, was also passing orders, and they were treated as an additional commissioner is also a joint commissioner. Now it has been still more. The power has been given to the assessing officer itself, even it is an ITO. He has a power to pass an order under 271D or 271C with the prior approval of the Joint Commissioner. So earlier it was only the JC who had the power to levy penalty on these big cases wherein there had been a cash transaction, and penalty on the cash transaction will be done under 270. Now it has been given to the assessing officer itself. So the assessing officer shall take the prior approval of the JC for passing the penalty order where penalty amount exceeds the limit specified in 274(2). And this amendment will take an effect from 1/4/2025. Then the socio-economic welfare, under the scope of perquisite, what had happened is that they have substituted any employer to an employee to whom the provisions of A to B of the subclause do not apply and whose income under 38, exclusive of value of all benefits or amenities, not provided for by way of monetary payment, exceeds 50,000. This has been substituted as such amount as may be prescribed. We don't know what will be the amount that will be prescribed. So as on date, it was 50,000. Now we have to wait and see as to what would be the amount that would be prescribed. And with regard to the travel allowance also, it does not exceed 2 lakhs. Now it has been made as substituted with such amount as may be prescribed. So we have to wait and see what is the amount that is going to be prescribed. And this is on the income from house property. Have just extracted the earlier provision and the new provision. Earlier it says that in the occupation of an owner for the purpose of his own residence or cannot actually be occupied by the owner by reason of a fact that owing to his employment, business or profession carried on at any other place, he has to reside at other place not belonging to him. The annual value of such house or part of the house was taken as nil. Now the substituted provision is that the annual value of the property consisting of a house or any part thereof shall be taken as nil if the owner occupies it for his own residence or cannot actually occupy it due to any other reason. So this applies to 2 houses, that is, allows this benefit only in respect of 2 of such houses shall continue as to apply as earlier. So this is a new change with regard to the annual value. So you have to make some.
Yeah, this is something I was thinking like more like a concept of deemed self-occupied, because earlier we only used to have the concept of deemed let out. See, what happens is here, one house I have, other house I have, that is supposed to be self-occupied, but I am not able to occupy it because I'm employed somewhere, so I'm living in some other place. Because of my occupation, I have to go there. So then it is deemed to be self-occupied. So there earlier, the reason was very, very specific. I could not occupy this because of my employment or any other reasons. I don't live in the city, then and then alone, I will treat it as self-occupied and the value will be nil. Now, I think they have liberalized it to say that I did not have only that reason that I could not occupy because of my work or anything. Any which case, for any reason, due to any reason, if middle class.
Yes. Tax administration, sir had dealt with the penalty, the TDS issue. So the next one, sir. 276BB was also dealt by sir.
Yes, yes.
270A, it is an extension of the immunity. Earlier, the section was within a period of 1 month from the end of the month in which application is received. We have to, the assessing officer has to pass an order. There was a time frame within a period of 1 month from the date on which the application is received. Whereas now they have extended the time frame. The next one, it says that, so it is proposed to amend subsection 4. There had been an extension of about another 3 months, extending the process period to 3 months. Earlier it was 1 month. Now it has been extended 1 plus 3. So it has been 4 months. Overall in the budget with regard to direct taxes, we can see that there had been an extension of time frame. We had been taking a lot of writ petitions were filed on the limitation issue day in, day out. But now I think to curtail these kind of technical issues, they have brought in a lot of amendments with regard to extension of the time frame. 270AA is one other provision wherein there had been an extension from 1 plus 3 to 4 months. Even with regard to 275, what had been made is that to provide that any order imposing a penalty shall not be passed after the expiry of 6 months from the end of the quarter in which the connected proceedings are completed or the order of appeal is received by the jurisdictional principal commissioner or commissioner, or the order of revision is passed, or the notice of imposition penalty is issued. Earlier, the provision was it should be time limit to impose penalty is end of the financial year in which the connected proceeding has been completed or 6 months from the end of the month in which appellate order is received. There was 6 months time that was available. Now there had been once again an extension wherein the end of the quarter, 6 months, expiry of 6 months from the end of the quarter in which connected proceedings are completed or an order of appeal is received by the jurisdictional principal commissioner. So once again, we can see that there had been an extension of time by about 4 to 6 months. Earlier, it was only 6 months. Now it has been 4 to 6 months. This amendment will also have an effect in 246A also, the time limit. Next one, sir. Updated return. So earlier slide, sir, for updated return, I had made a chart. Updated return is a concept that was introduced by Finance Act 2022, wherein if we have missed out any kind of an income, what had happened is that revised return, the time frame was very less. Updated return concept was brought in wherein 2 years time was given. Now it has been increased to 4 years, wherein an updated return can be filed, whereas it comes with a tax and interest payable. If the updated return is filed within up to 12 months, then the tax and interest payable would be additional income tax of 25% of aggregate of tax and interest payable. If it is 12 to 24 months, that is 1 to 2 years, then it will be 50%. If it is 24 to 36 months, that is 2 to 3 years, it would be 60%. If it is 36 to 48 months, that is 3 to 4 years, it would be 70%. Even though it comes with an additional income tax and the interest payable, still, in case if there had been any kind of a glitch with regard to there had been a delay in audit report or anything wherein they have missed out a particular amount, then this updated return concept is definitely a welcome move wherein they get a chance to update their return. But there is a lacuna with regard to this updated return. It is in the next clause. In case if there is a reopening that has been initiated, that is where the proviso comes into play. No updated return shall be furnished by any person where any notice to show cause notice under 148A has been issued. In this case, after 36 months from the end of the relevant assessment year. So with the 3 years, 1 to 3 years cases, then the possibility of updated return may not apply if a 148 proceedings kicks in. Then in case if 148A, if there is a dropping of the proceeding, if it is within 3 to 4 years, then you can definitely file an updated return. So this comes with a proviso kind of a thing, and it comes with an effect from 1/4/2025.
There is a couple of problems here because if you see the finance minister's speech or the memorandum, actually, it says it is to nudge people towards voluntary compliance. But it is very, very costly. You talk about 70%. This 70% is over and above our regular tax. So regular tax is 30%, and someone is saying in the bracket of 1 crore or so and missed, say, 20 lakhs to be disclosed for genuine reasons. Some expense got, suppose we showed it twice or some other reason. So we realize that. And then we say that this has to be corrected. And we come after 3 years. I pay the normal tax, normal surcharge, normal cess. And then over and above that, I pay interest. Interest itself will be around 40%, 41.05% if it is 3 years, because we are not talking about 234C will be around 5.05, 234B will be there. So that will come to 41.5. So 100 rupees tax, then you have to pay 41.5% on that. So 141.5. On that, you have to calculate 60%. And that amount you have to pay again. So it is very likely that it will cross the actual income itself. It will go beyond it.
But earlier what had happened is that in case if there is a reopening, we can file the original return itself and make some kind of a revision, and you can file another return. Return will be treated under 148 as an original return itself. Whereas after 2022, that particular clause had been removed.
Let us assume that there is no 148 proceeding, and I discovered it myself. Earlier, the time limit for filing the reverse return would have expired, but still we go and disclose to the officer and then say this much. Penalty will not be there. We pay usual tax and interest. That is what is, if we are nudging anyone towards compliance, then it should be attractive also. If a person would have already, a person, normal, regular taxpayer, honest taxpayer, he would have done earlier like this. Now with this updated return, he will be paying penalties for this. He will be paying additional tax at special rates on interest also.
But I feel this updated return is some kind of a relief to the assessee in one way, because what had happened is that in case if there is some kind of a revision that we have to make in the return, we have to go through a procedure wherein a 119(2)B petition has to be filed. And we had been seeing cases wherein without hearing, there had been a rejection of all these 119(2)B. And even if it is more than 50 lakhs, it has to go to the CBDT. And it is not, the order is not passed for a very long time. So this updated return may act as a kind of a remedy for those assessees who want to clear their lacuna, which they haven't done.
But if suppose I cross 3 years, then the 143 time limit also gets over. Whether you will file at all is another question.
Let us see. Yeah. This is also, and once again, an extension. I'll just read how it was earlier and how now it has been substituted with regard to the period of limitation. I think overall in the budget, we can see that the limitation period has been extended, but we have to see how it can be calculated. Earlier, how it was is section 153, explanation 1. For the purpose of this section, in computing the period of limitation, the period during which the assessment proceeding is stayed by an order or injunction of any court. This was only the line that was available earlier. Now the substituted one is the period commencing on the date on which the stay on the assessment proceeding was granted by an order or injunction of any court, and ending on the date on which certified copy of the order vacating the stay was received by the jurisdictional principal commissioner or commissioner. So we may not know when they receive it. They may even make it a later date, so that they can say that the limitation period has been, it has been extended because we have received only on a particular date. So this is going to be a tough time, and I may not know whether this may be subjected to challenge, because this will give a larger limitation period for the department, and there is no controlling provision over there. It just says the date on which the certified copy of the order vacating the stay was received. They may even make it, even though they would have missed it out, they can even date it at a later point of time. So there is a complete...
So when we say was received by the principal commissioner, whether it includes received by the office of the principal commissioner?
It is the office, jurisdictional office of the principal commissioner.
I think if it had been the date of dispatch, no, if it had been the date of dispatch, perhaps, we would have some kind of a controlling mechanism rather than the receipt. It's going to be a difficult. Litigation is expected.
One more point that has to be discussed over is its certified copy. According to us, even if it is onto the, if it has been published in the net itself, in the High Court website, we take it as a copy. Whereas what they would say is the certified copy is the date on which the registry issues it to them. From that time, it has to move on to the Principal Commissioner's office. So once again, there is a timeline that has been extended. From the date on which they have received it, from that date onwards, we don't know when they are going to receive it. From that date onwards, we need to calculate the period of limitation. It's going to be an extension with regard to 153, 144BA, 153B, 158BE, 158BFA, 163, 264, and 68B. So this may have to be subjected to challenge because it gives an enormous time frame for the department, so that the time limit, the limitation, the entire structure of limitation that has been prescribed under 153 is being enlarged. The scope of the section is being enlarged.
But can the SSC not give the certified copy? Will forward the certified copy, and the date can be stopped there. I mean,
The department rarely approves that.
Serve a certified copy.
No.
They would say that.
No, I think Ms. Maithili's question can be put like this. It says certified copy was received by the jurisdiction principal commissioner, from whom is not said.
Yes. That's what I'm trying to say.
But we may have to apply 2 copies then. One for us and one for the department.
Your copy,
also.
doesn't matter.
That's okay.
Yeah.
The next one is with regard to the search assessment. There had been an inclusion of VDA in 158B. Then this is a new change that has been brought in. Assessment of total income is pending in relation to an assessee on whom search is initiated. The word pending is now substituted with required to be made. So it need not be the assessment order has been passed, that has been made as pending. Even if it is going to be passed, required to be made. So this is it once again enlarges the scope of the search assessment. Then earlier it was only a assessment and reassessment. Now it has been assessment, reassessment, recomputation or reference or order relating to any assessment year. So there had been the scope of the word assessment, reassessment has now been included with recomputation, reference, order relating to any assessment year under the search provision. And under 132 also, once again, there is a time extension. It provides that the time limit for taking approval for retention shall be 1 month from the end of the quarter in which assessment or reassessment or recomputation has been made. Earlier, what had happened is that from the date of search or the date of authorization, the time limit of 2 years, whatever it is, will start kicking. Whereas now, they have made it 1 month from the end of the quarter. So there had been once again an extension. This budget had been only for an extension of time frame at all point of time. And the word authorization has been made as authorization, then authorizations.
Just 1 minute, Vardhini, sorry for interruption. In this slide, what is the impact of this? I mean, saying that assessment, reassessment, recomputation and reference or order, what would be the impact? In the sense, it could only be an assessment or a reassessment. Is it? Recomputation would also fall within that, isn't it? So what is the impact of it?
Recomputation reference means if there is going to be once again, the assessing, if there is a tribunal passes an order wherein they send it back to make a recompute or remand it back, then that comes under the recomputation. Or there is a reference. There are situations where there can be a reference by the officer to the assessing officer to take a particular note of a particular entry which has been missed out. So all these things have also come within the scope. Sir, hope I'm right, sir.
Yes.
Thank you so much. Thank you for the clarification.
Now, the methodology of computation of total income of block period, this has been amended. So the first substitution has been earlier the word was
suggestion is considering the paucity, this block period also maybe we can skip, not something which we.
The only thing that I wanted to make is earlier the word is undisclosed income. Now it has been substituted as total income disclosed. Sorry, it was total income disclosed with undisclosed income, which has been declared in the return. There had been a change in the words. Next one, sir. Same time limit. Once again, there had been an extension in this block assessment also. The last one would be the faceless scheme. This is a moot point that can be brought in because the faceless scheme will not apply now immediately for 92 CA, 144C, 253 and 255. This is with regard to transfer pricing and also with regard to ITAT. So it's not going into the faceless mode as of now, and it will take till about 31st March 2025. All along, we had been having a faceless mode with regard to the
144C is DRP, right? That also.
DRP, yes. Transfer pricing and then the ITAT. So earlier, what had happened is that the faceless had been brought into the assessment, reassessment, and then with regard to the National Faceless Appeal Center, that is the CAT appeals, where over there, the cutoff date was 31st March 2022. In spite of that, there had been cases wherein the jurisdictional assessing officer had been passing orders saying that they would fall under the proviso. So maybe the clarification as to the cutoff date, there had been an extension for these categories, can be taken it for a benefit wherein saying that for those cases, 2022 is the cutoff date. There cannot be any kind of a jurisdictional officers passing an order as the faceless regime has been come into force in totality with regard to the assessments, with regard to the appeals, and also with regard to the reassessments. So let us wait for the next income tax, comprehensive income tax act that comes into play and see what are all the other changes that will be brought in. Thank you.
Well, there is also one issue here where one judgment has been nullified. That is there in income tax also, like we talk about safari retreats, etc. That is with respect to that CTC judgment of the Bombay High Court, where it was there. That is when we talk about 87A rebate, whether that 87A rebate is applicable only for normal rate of tax or special rate of tax items also, whether the 87A rebate was there was an issue. If we see the earlier provision, it will not talk about normal rate, special rate, nothing will be there. It will not talk about 115 BAC only, etc. So therefore, the practice was for the assessees to apply the rebate as it is for all tax which is payable, irrespective of whether it is capital gains like 111 or 112 or whatever, special rate or normal rate, no one bothered, it was claimed. But what happened was the portal didn't allow claiming this rebate for special rates. It was allowing only for normal rates, slab rates. When I say normal rates, I mean slab rates. It was allowing only for that. There, a public interest litigation was filed by Chamber of Tax Consultants, CTC, in Bombay High Court. And Bombay High Court dealt with the issue and then said when 115 BAC is not talking about anything, 111, 112 or any of those provisions are not talking about anything, 87A is silent about this rebate can be applied to which one. When all of these are silent, how can the portal bring in such restriction that rebate is allowed only for normal rate, not for special rate? So therefore, the Bombay High Court directed the Income Tax Department to amend the portal to allow the rebate on special rate items. So the direction was to correct the portal in line with the legislation. The budget has amended the legislation to be in line with portal. Now the amendment has been brought in saying that 87A rebate is applicable only for 115 BAC slab tax. So therefore, the reverse has been done. So as such, they have brought it at par, but portal becomes supreme and legislation can be amended in any budget. That is no problem. Like what Mr. Sujit Ghosh was saying yesterday in somewhere in the chat, that if this is the way the government is going to nullify the effect of judgments, then advocates have to only take sannyas. Vishwas, sabka prayas. So add one thing, sabka sannyas also. That is something we can. Okay, anyways, thank you very much, Vardhini. Thank you, Madras Tax Bar, for the opportunity. If there are any questions, of course, we can definitely take it up.
Raghavan and Vatini, I have one small question.
Yes, sir.
On this TDS for renting 6 lakhs, is it total 6 lakhs for me, or each owner it is 6 lakhs from tenant point of view?
Sir, there are two things. One is for each month it is 50,000. It is not 6 lakhs. So 1 month it is for you 40,000, another month 60,000. Then there is a problem. It is not in total 6 lakhs.
Okay, no, let me say
No.
two buildings are taken on
No,
rent.
that is number one. I know I
Ah.
didn't answer your question,
Ah.
but I'm saying, clarifying on this 6 lakh, it is not absolute 6 lakhs, it is 50,000 per month. Second one is, this is an usual problem where in TDS, we are talking about the person who is paying the amount to the actual person. This fellow will not know from where that person is receiving. So if this person himself is paying for 2 different properties, he is aware, then it is not 50,000 per property. It is 50,000 per month payable to one person. But if he is not aware, then he can go with 50,000. He need not know from which other property the other person, the landowner, is receiving money. That he need not know. So he will stick to 50,000. But if this fellow himself is paying more than 50,000 for more than one property, then it is not property wise, it is the person wise.
Okay. To put it as an example, I have taken 2 premises on rent, 30,000 each. I have to deduct.
From the same person.
No, different persons.
No, then you don't need to bother.
That is what.
From the same person is what we need to see.
Okay, got it.
I think Senior Counsel Mrs. Pushya Sitaraman is here. She can also say a few words.
I think now she was not there. She was there some time back. Name is not visible.
Yes, not visible.
Then our Dhoni is here. Dhoni
APS.
is here.
With regard to the amendment, now it is made where the certified order copy is received by the principal commissioner. Already there is a judgment by Justice Sivanjanam in the case of Madras Race Club or MRF. This is clarified. See, the problem faced by the department is if the stay is vacated, it is not communicated to the department immediately. So in that case, how the limitation has to be computed. And another case is when the final order is passed, even then when it is not communicated and the assessee now comes in writ it. So how to compute the interim period. So even then the judgment by Justice Sivanjanam says that it has to be communicated to the department, then only they know about the vacating of the stay or the dismissal of the particular case, because the limitation already it's running. So after the starting of the limitation only the assessee comes to the litigation. So the stopping of the limitation also should be known to the department. So on that idea only the amendment has been brought. So it is no way it is extending. Even otherwise it's practically the department is taking the way when it is communicated to the department. And the another thing is communication to the department means it is communication to their standing counsel. So the assessee need not to worry because the department is represented by their counsels. So a communication to the counsel is as good as a communication to the department. So therefore it is no way extending the limitation. It's what practically followed is now made as a statutory amendment. That's all.
I have a slightly different view here, but
Yes.
but I of course acknowledge that this view, what you are saying, is also possible. I'm not saying no to it, but I have a slightly different view here. Number one, we are talking about not talking about the communication to the principal commissioner, which of course it has to be communicated. Anyone, only when they are communicated about the order, they can implement anything. So there is no doubt about that.
Yes.
And the problem we are talking about is certified copy.
Yes.
And to the principal commissioner.
No, that means it includes their counsel. It is already clarified in several judgments.
No, that is what is important. So if that clarification comes, then it is easier for everyone.
No, it is under the Tamil Nadu General Sales Tax Act. The similar word is there. There, our High Court has said communication on the state representative. So they are represented by their own people. So even a communication to the state representative has to be taken into account as communication on the department. So it's there, sir. Yes. Any other thing?
Mr. Ramana Kumar is here, I think. He can also say a few words. He can his
Yes.
thoughts on this.
Yes, Madam. Thanks a lot for the opportunity. I have a few issues to raise. One is that, on this certified copy, on 30th January also, we got one order from Justice Shafiq that, to say that the certified copy is not necessary and the web copy can be accepted as the copy for the department to proceed along. Was the judgment was passed by him, on an income tax matter. I think it is Akshaya Homes, I guess. So that is one thing. And the second thing, there are a few anomalies with the increase of the limit from 4 lakhs to 12 lakhs. A lot of other limits also have to be similarly increased in the same ratio. One limit is that 44 ADA for professionals, especially which will directly affect us, people like us, is that it is still at only 75 lakhs. It can also be increased in case the chamber is planning to have any memorandum to the budget or recommendations on the memorandum. We can include that all the similar threshold limits can also be increased to the extent that it has the same effect of the 12 lakhs increase of limit. So these are the few thoughts I had. And, actually, if you see the increase of 12 lakhs, in fact, I had a debate yesterday also in one of the channels where they said, even if you increase 12 lakhs, the benefit is only 60,000 or 80,000 rupees. So that is not the way to look at it. The way to look at it is that the income tax has been, simplified. Slowly, it is becoming a compliance law. Income tax of all acts are becoming a compliance law in the sense that scrutiny is being reduced. The finance minister also has told that for reduction of litigation, the government is taking enormous steps. We have to see how it is going to rectify, especially after hearing Vardhani to say that all the timelines are extended and the limitations are being extended. That is also a point to consider. Let us see what really happens in the finance bill.
Like section 169, sir, the easiest, because GST is a simple tax. We know it's very easy and compliance oriented. 169 says that once it is uploaded in the portal, it is deemed to be served. Likewise, here also, once the order is uploaded in the High Court portal, it should be deemed to be served on the principal.
Yes, that should be done. In fact,
that is how simple taxes work.
Yes, in fact, for the government council, we are facing another problem. Unless we give the certificate copy, our bills are not being processed. So we have a different problem altogether. So all this would be solved, I think, with this. Let us see.
Sir,
Thanks a lot for the opportunity.
Really, the enhancing the tax limit up to 12 lakhs is a laudable object only. So no doubt beyond 12 lakhs, it is taxable in the slab rate. But the exemption up to 12 lakhs who is earning is really a laudable object. The government has tremendously enhanced the limit.
Sir, someone asked the government to reduce income tax. They thought they are talking about the size of the book. So the announcement is they will reduce it by 50%. So
We'll come next week, no?
Tax is reduced, only the act is reduced. If there are no further questions, maybe we can, because it's already 1:15.
Yes.
Thanks a lot for the opportunity.
Thank you very much. It has been a very interesting and contrary to the disclaimer by Raghavan, it's been quite exhaustive, Raghavan and Vardhani, on income tax. The changes have been quite, the entire session has been so engaging. Any further questions? Otherwise, I think Aparna can summarize and we can close on to that.
Actually, Maithili, I'm facing some network issues.
Okay.
So there's fluctuation. So I think you can do it. Because,
Okay.
yeah, it may go out.
Okay. Thank you, Aparna. when we started off, as Madras Tax Bar, the most logical thing to do was to have a webinar and have this on this platform, and which MTB is known for. And it was indeed the entire flow was very good. We had excellent speakers. The first, Hari Radhakrishnan started off with the detailed analysis of the amendments, changes that have been brought about in customs, giving both a bird's eye view and the specifics on settlement commission and certain other on provisions on finalization of provisional assessment and all of that, and the interesting changes that have been brought in customs. This was followed by the session by Natarajan and Aditya. They did a tremendous job. And of course, as would not be surprising, we went back to safari retreats. Somehow that set in motion more and more questions, and all of us have our own answers to it. And we should have another session devoted to the implications of whether it is in fact been completely annulled or there is really a way out of safari retreats. And this is something I think at this stage we should not discuss, because the review petition is pending and we don't know what will happen. That will also try to get reviewed. So there will be an attempt. So I think we will, as of now, we can keep the discussions at bay and see what happens with the review petition, and thereafter we should plan a session. And for the income tax, as I said, Raghavan and Vardhani did a brilliant job. It was quite exhaustive. The changes were all discussed threadbare. And we also came down to the question of when is a certified copy served? Is it treated to be served? Who should serve it? All those aspects were analyzed. And of course, just to add a bit, a certified copy is when the date when it's made ready, as we all know, is what really matters. And whether web copy we can claim is service of order. These are all, of the availability of certified copy, whether it should be equated and any further clarifications are required in this is something that was mooted. Thank you, all of you, for attending this elaborate session and spending an entire Sunday morning. It has been extremely gratifying and educative, and the fine inputs that came in the form of questions thoughts from Aparna, from Mr. Gokarnation, Mr. Ramanakumar, Mr. Krishnanand. It has all added a lot of value. With this session with A.P. Srinivas, because the Dhoni of Madras Tax Bar had his say, which is very useful. Thank you very much. Aparna, are you still there? Can we close the session? So I think with this,
Yeah, I think we can.
Natarajan,
Yeah, I think
would
we
you
can.
like to? Yeah, we can close the session. Thank you for the